Good morning. At this time, I call the April 16th recess meeting of the Nash County Board of Commissioners to order. This meeting will be a fiscal year 2026 budget work session. On behalf of the commissioners and the staff, I welcome everyone to the meeting. We begin our meetings with an invocation and the Pledge of Allegiance to the flag. For the invocation, you're welcome to stand and join us, or you're welcome to have your own individual prayer, or you can use this time for a moment of silence. Commissioner Fred Belfield will give the invocation, after which I will lead us in the pledge. Commissioner Belfield.
Let us pray. Trust in the Lord with all your heart and lean not on your own understanding. Father, we've read that and we believe that we understand it. We come before thee to just thank you for this day. We come before thee with our fiscal 26 budget. We pray that you give us, as you did Solomon, wisdom, knowledge, and understanding of how to work this budget out, that it will be pleasing in our sight as well as your sight. Now we're ready to begin, and you said where there are 2 or 3 meeting, you are in our midst, and we believe you are. So bless us as we move forward. These blessings we ask in your name. Amen.
Thank you, Commissioner Belfield. Would you face the flag and join us in the pledge? I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Now I want to call on our county manager, Stacy Schatzer, to start our meeting today with a review of budget focus areas, followed by other items as listed in the agenda at your seat.
Good morning. I'll just give you a little lay of the landscape of what's in front of you before we get started with the agenda items. You've got a packet in front of you, and you've got some materials that are paper clipped together that starts with your agenda. The items behind your agenda are just some additional items that we will visit throughout the day. Sometimes the print on the screen is going to get kind of small, and the print in your PowerPoint packet will get a little small. So we've provided you with some additional larger print items there. And then, as I just referenced, you've got a copy of the PowerPoint in front of you, so you can follow along. Certainly if you can't see what's there on the screen, you may be able to see better what's here in front of you. We have Mitch Berbriglio coming from Davenport and Company, and if he's not here when we're done with the first section, we'll skip and go on to Jonathan Boone with the CIP. I do know that the items that are in the packet here that are for Mitch are small. Know that when he arrives, he will have the full packet printed for you all, so you all will have a good size in front of you to be able to follow along. Jonathan, can you help me with some of the logistics as far as restrooms in the building so that folks know where they can go?
Yeah, if you would, so go ahead and disclaimer, we want to manage expectations. We're in a building that's been closed for a little while, so there's some gremlins that we're dealing with today. But the bathrooms are located, if we go back out in the hallway, there's a staff lounge next door to your left. We just go through the staff lounge, there's a door at the back, and then the bathrooms are immediately to your right, men's and women's. There are some obviously here, there's some on the hall, but we encourage everybody to use the ones attached to the staff break room. Again, go back out in the hallway, first door to your left, doors propped open, lights on, walk through the break room, you'll see the bathrooms to your right. Outside of that, I think we'll cover the rest. Any questions? Any other thing I need to cover? Excuse me? Starbucks is, yeah, they're on the way. Might not be here today, but they're on the way.
Mitch, please, you're right here at the end of the table.
Oh, thank you, sorry.
You. No, good to have you. Okay. We are not live streaming. We're just being recorded. What? Excuse me. Well, good morning again. Just want to take a moment to walk through some of the budget focus areas that we identified from board members. If you will recall, back at the beginning of this budget season, probably 2 months ago now, I asked board members to send me what you felt like would be budget focus areas, and we narrowed those down and provided those to you in your first set of small budget meetings. And so the first focus area that we identified was for our employees with a cost of living adjustment and a merit pay system for employee recruitment and retention, and continue to focus on efforts on making Nash County an employer of choice with competitive wages and a benefits package. And later on today, we will be talking about the potential for a new broker for Nash County for our ancillary benefits. So these are not, this is not our major health insurance benefit, because that is through the state health plan, but all of the other benefits that we offer to our employees. And then our second focus area is on existing capital projects and infrastructure needs to assist with the recruitment of industrial clients and to enhance economic development. Our third focus area is to ensure replacement of end-of-life equipment, technology, and vehicles for safety and efficient business practices. The fourth focus area is on building safety and security enhancements for the overall well-being of our staff and citizens. And then our fifth focus area is to hold the tax rate steady and to take an overall conservative approach to spending while monitoring changes at the federal government level. The next item on the agenda that I wanted to address, as I did last year with the board, was the Blooming Festival. As you all know, this is a big annual event in the town of Nashville each year, and this year in particular, with enhanced security, the town is planning on fencing off the festival area and having 4 points of entry. So even more so, I think it's important for us to address our staffing on the Friday of that event. So on Friday, May the 9th, I'm asking that the board consider allowing us to do what we did last year, which was close our offices at 2 p.m. on Friday afternoon and provide our staff with 3 hours of PTO time to cover that. And
Is there any objection to that from the board?
I have a
Go
comment
ahead,
or
Commissioner Wilson.
a question.
yes, ma'am.
How is us giving them the 3 hours PTO different from when there's inclement weather and they have to use their time then? Why do we not do that then?
Because, I'm sorry.
No, go ahead.
Because the inclement weather situation is addressed by our PTO policy. We put a policy in place 3 years ago to get rid of just providing administrative leave for weather. So 3 years ago, we started providing employees with 16 hours of PTO annually to manage inclement weather situations. The first 2 years of that policy being implemented, we did not have any inclement weather scenarios, so staff did not have to use any of that PTO. The policy states for our staff that those hours are there for them to use in an inclement weather situation, and if we exhaust that, then it goes into their own time, either comp time, annual leave that they have built up. What's different is the fact that we have it covered by a policy. This is a one-off situation that I brought to the board last year because of this festival that's in our downtown area. And again, we have enhanced security coming this year, which is going to fence off the area, and I just feel like it's necessary for us to allow our staff to leave work and get out of town. Yes, sir.
Mr. Davis?
It appears like the chairman is asking for a vote on this today. Are there other things in this work session today that we're gonna be asked to vote on? I didn't come here prepared to vote on any item today.
Okay. We do have,
I don't know that you're asking for a vote on this, you're asking
For consensus to allow you to close the office at 2 o'clock.
I
Is
am,
that correct?
I
And
am.
we do have 2 items that are on the agenda we'll consider today for action.
Does that answer your
You want to
question?
identify those now?
Please.
All right, one of them is the budget amendment for the Nashville properties, and the other is consideration of the employee benefits broker, which will be after lunch. The Nashville properties, which Mr. Gaynor negotiated. And I think everybody's aware of the price that was negotiated for those properties. But again, I don't think you're looking for a formal vote on this. You're just asking the board's consideration and agreement to allow this 2 hours early.
I am.
Okay.
Could I get the difference between those two items explained to me then, Mr. Attorney?
What are you asking?
I'm thinking we're voting on it, we're asking for consensus. What is the net effect difference between those two actions?
I mean, I guess in theory, there is no difference in what you're asking, what you're asking, but
Thank you.
I'm not sure that,
That's good.
okay?
So we good with consensus? Commissioner Howard?
I'm good with it. I just would make sure, after we go ahead and start notifying the public, because I'm assuming that we're going to also block off access to them being able to get to the administration building as well, or it's going to be very limited, so we can go ahead and prepare the citizens to make them aware of it, just so they can prepare.
Yes, sir. Last year, we had our communications department help us with signage, and we put that signage up, I think, more than a week ahead of time to start letting citizens know that we would be closing at 2 p.m. on that Friday.
What all departments does this apply to? Is this only staff in the county administration building, or is this courthouse? Who all does this apply to?
So, well, the courthouse, we don't oversee court staff. It's for county departments, whether they're in the town of Nashville or not. So it's across the board for county departments.
So all county offices would close at 2 on that Friday?
Yes, except for our departments that are essential employees, like our EMS and sheriff, 911. But the PTO would apply across the board. I'm asking for the PTO to apply across the board, just as our PTO policy does.
Any other questions? Discussion? Go ahead, Commissioner Ward.
We may want to discuss this further, like further in advance next year. This is a festival that goes on each year, and the date's set well in advance. And I'd like for us to maybe discuss it a little bit further ahead, so that we can give the public plenty of time and our board plenty of time notice as well. Thank you.
Any
And
other-
when we do, I'd prefer that we discuss it for moving forward, so we
Yes,
don't have
right.
to address it annually.
Thank you.
And things could
Commissioner
change.
Belfield, go ahead.
Things could change, so you play it year by year, and rather than just setting a policy, but do it in time so the people would know.
Commissioner Wilkins?
Last year, wasn't it 2 hours?
No, we closed at 2 p.m. It was 3 hours.
3 hours. What is the financial ramifications? Do we know? how much it's costing the county to give these employees that 3 hours?
Looking for my HR, we do not have that data for you at this point in time.
Other questions or discussion? If this board would prefer to take a formal vote, I have no issue with that. I'm good with either way. What's the preference of this board?
One more question, Mr. Chairman.
Commissioner Davis?
Is our May meeting prior to this date?
Our May meeting is May the 5th.
It is,
So it would
yes,
be,
sir.
this is May the 10th, or the 10th, 9th, or the 11th.
It would reduce our ability to post it for the public, but it is before this event.
What's the pleasure of the board?
Mr. Chairman, I think you need to take a formal vote.
We'll do that, Mr. Gainer.
If it's going to affect-
Any other discussion?
I'd just like to say, based on what Commissioner Leggett said, I'm prepared to vote for it today, but I certainly would like to have more notice of this in future years.
Understood.
Make a note of that, Ms.
Understood.
Manager, and next year you can give more notice. Any other discussion or questions? Hearing none, the recommendation is a request to close the county office at 2 p.m. and provide staff with 3 hours of PTO as was done last year. Any other discussion? All in favor indicate by saying yes.
Yes.
Opposed, no. Motion.
Mr. Chairman, can we get a motion? and a
Oh, I'm
second?
sorry. I'm
Yes, sir.
sorry. I thought that, I'm sorry. That is the motion. Would you, got to get a motion on that?
So moved.
Moved by Commissioner Leggett, second by Commissioner Davis. All in favor indicate by saying yes.
Yes.
Opposed, no. Motion passes.
Thank you.
Go ahead, Ms. Manager.
And the next item on our agenda is a budget amendment that is needed for the Nashville properties that we've discussed, and I'll ask Ms. Nikki Stanton to come to the podium. Thank you.
This is a budget amendment number 11. It's presented to the board's consideration for the acquisition of property at 219 North Richardson Avenue and 110 West Elam Street in Nashville. $214,500 fund balance for the acquisition.
Any discussions or questions from the board? Any discussion or questions? Any staff comments?
I will say that part of the negotiation, the county attorney arranged for 7 days of due diligence, which is not allowed for a lot of time to hire someone to come in and assess the property. Not that we really anticipate any problem. We've done a cursory review of the property, did not see any visible signs of underground oil tanks, anything that might require environmental remediation. So we have done that. But we anticipate certainly we'll demolish the property.
Other questions? Does everybody understand the recommendation? Is the recommendation clear? Is there a motion?
So moved.
Moved by Commissioner Davis, second by Commissioner Howell. All in favor indicate by saying yes.
Yes.
Opposed, no. Motion passes. Thank you, Ms. Stanton.
Thank you.
Dr. Stanton. All right, next on our agenda is Davenport and Company. Welcome, Mr. Bergulio, is that correct?
Mr. Chairman, you nailed it.
Any way I say it, okay. Well, we're glad to have you with us, and the podium is yours now.
Yes, sir.
You'll be discussing fund balance, debt profile, and capital funding analysis.
Got some hard copies for you all as well, that may be a little bigger than what's in your packet.
Thank you, Jonathan.
I do have their slides in there.
Okay, perfect. Do you want me to flip through? Yeah, okay, perfect. Well, good morning. Oh, yes, sir.
Before you get started, do you want questions as you go along, or Are you
Yes,
good
sir.
with that?
I'd love to keep it conversational.
Okay.
I think some of y'all know us from the past. We're happy to answer questions along the way, dive in. I'd much rather it be a conversation and you all get the information that's helpful to you all as opposed to me just talking
So
all
I'd
the
ask the
time.
board if you have questions, then be recognized so we don't talk over each other. Go ahead, sir.
Yes, sir. Mr. Chair, members of the board, thank you all for having us back again to your retreat this year. Again, Mitch Bergoglio from Davenport and Company, been the county's financial advisor for a long time now and helping with capital planning and funding of capital projects, particularly through debt issuance. And today, going to talk a little bit about fund balance and the planned FY26 capital, which is in line with prior year plans, and kind of getting to the point where we've got a number of capital projects that are going to be funded in this coming year. So wanted to give you sort of a deeper dive into the fiscal year 26 funding details, and there's an associated financing with that if you choose to move forward with that, and give you a sense of the kind of coming steps associated with that financing as well. So there are page numbers in the bottom right corner of the books I handed you. I'll try to reference those along the way and keep the slides up on the screen here. Starting out just at a very high level, anytime we're talking about funding capital and the potential financing, any potential financings associated with that, the county's credit rating is an important aspect of that. Just like ourselves, when we go out for a mortgage or to get a car loan and we have our credit score pulled, lenders, banks will evaluate the county's credit before they offer a loan, and the strength of that credit will determine whether they will offer a loan and at what interest rate, have an impact on the interest rate that they will offer you that loan. In the municipal world, the world of public finance, county government, ratings are often not done in terms of absolute numerical scores. They are letter scores, with AAA being the highest, best credit rating you can have from one of the national credit rating agencies. The county has a very strong credit rating at AA2 from Moody's, AA from Standard & Poor's. That is 2 steps away from the absolute highest credit rating that you can get. So that positions the county nicely if you choose to borrow money to fund capital projects, positions you to access the markets at attractive interest rates. And so as we go through this planning process, we do look at some of the key credit factors that the rating agencies and lenders, banks will take into consideration when evaluating the county's credit, so you have that information when making funding decisions. The right-hand side of this page does provide you a little bit of insight on where others are rated, both nationally and in North Carolina. Not everybody has a credit rating from the national rating agencies. You only need a credit rating if you issue bonds in the public bond markets, like you all have done in the past with general obligation bonds and limited obligation bonds. So I thought it would be helpful refresher just to look at what goes into that credit rating, right? So as you all are working on the budget process, as you all look to fund capital projects, what are the considerations that these outside rating agencies or lenders look at when they evaluate your credit? And I'll talk off of the upper left-hand corner, chart from Moody's Investor Service. They look at 4 key areas: economy, financial performance, institutional framework, and leverage. And they use these categories to come up with a quantitative score. It's very formulaic driven, and they come out with an indicative score. And then from there, they can make more qualitative adjustments as the analyst sees fit. But starting out, understanding their methodology, I think is helpful. They look at 30% of the overall rating as economy. So this is things like median household income of folks in the county, assessed value of the county, assessed value per capita. GDP is often a consideration of the county. So these type of demographic and tax-based items are not something that you necessarily have direct control over as part of this upcoming fiscal 26 budget process, right? You can put, zoning policies, economic development strategies in place to try to encourage economic development with higher paying jobs, et cetera, but that is outside of your short-term control. There's nothing you can adopt immediately to bring in private industry that pays good jobs. You can certainly influence it, but nothing you can directly do to have an impact. Similarly, institutional framework is 10% of the overall rating, and that's your county in North Carolina arranged under the North Carolina General Statutes. And Moody's evaluates that compared to other states. And they look at things like counties being responsible for school capital, and DSS, and public safety, courthouses. And so they rank you all and all North Carolina counties in their second highest category in that. Nothing you can really do to that unless there's a significant change in the statutory responsibilities of a county. So that really leaves 60% of the rating from there. And these are things that you do have direct control over. It is financial performance, so your fund balance levels, your budgeting. Do you have a balanced budget with revenues covering expenses, and those absolute fund balance levels? And leverage, which is just their fancy way of saying your debt and liabilities. So basically the debt you have outstanding and anything that you may have to pay in the future, things like pension liabilities, factor into these calculations. And you all have control over the amount of debt you issue. Now, once you decide to fund and approve a capital project, if you intend to fund it with debt, if you don't issue the debt, then that has an impact on the financial performance side of using fund balance. So the two are somewhat related, but you all, as a board, have control over how you set the budget and how you choose and what capital projects you choose to fund, which influences that debt side. So those are kind of the pieces that we'll focus on this morning, give you a little bit of perspective on those things that you do have control over.
Mitch, could you tell us the one thing that Nash County could do to elevate our rating as it stands now that you see? I look at the counties that we're grouped with and the counties that are above us, and I would think that we could move up by doing something. What is something?
Yeah, I think that's something is economy. Impact on your economy, growth in the tax base, growth in income levels in particular. Unfortunately, right, I know y'all are working hard, and that's been a big conversation with the rating agencies. The growth you all are seeing in the economy has been a positive discussion. But that's the piece where they're comparing you all to the Wake counties of the world and the Durham counties of the world and others throughout the state and the country, and those levels are a little bit lower. One of the things that we've talked about a lot is they look at it more broadly than just Nash County. They look at it regionally and on an MSA basis. So that piece of things impacts the calculation of Nash County's income levels as well. So, where you may be growing more quickly than others in the region, they still tend to look at things regionally. And I think that's just a process that takes some time to see that growth. We know the growth is coming. We know your location compared to the triangle and how that has influenced you all. But the rating agencies like to take a wait and see approach. They like to see the trends happening, and then they like to see those trends actually occur and stabilize before they really get to those next levels. And, when you look at where you are compared to others, Mr. Davis, I'm sure you were looking at it like, Johnston County is higher rated. They've got AAA from some rating agencies. You're right there, right? You're right on the outskirts of that, and it tends to grow outwards from those metropolitan areas is the trend we've seen. Yes, sir.
You good, Mr. Davis? Mr. Belfield?
What drive these ratings? Is it borrowing, use of fund balance?
Yes, sir. So the borrowing drives the need for a credit rating, right? So if you issue bonds in the public markets, if you don't just go to a bank and get a loan, if you issue municipal bonds in the public markets that are securities, that's where we kind of have the need to get a credit rating. And then when we go through the rating process is where this methodology that Moody's uses starts to apply. And that is absolutely the fund balance, yes, sir, and the amount of debt you have outstanding compared to your overall budget size. But it's also economy, which is your underlying assessed values, the income levels of your community and all of the demographics, population growth, all of those things play in as well. And that's where I think we see you stack up nicely on the things that you have control over, the fund balance and the debt. It's the things that are maybe more influenced longer term, like economy, where the ability to gain on that credit rating exists.
What role the economy play in those ratings?
So it's your couple of things, I think is the way they look at it. It is your ability to pay the debt service, right? A stronger economy means more revenue coming in, which means more availability to pay for the debt service. And remember, oftentimes when we issue debt, it's over a 15 to 20 year period of time. So they want to see that economy in a strong position to have a comfort level that not just next year, but for the next 20 years, you will have a stable revenue base to be able to repay the debt service.
Is it better for long-term debt or short-term debt?
So, I mean, positives and negatives of both, or I guess I shouldn't say positive and negatives, pros and cons of both, right? The shorter debt, less interest is paid, and you kind of free up room to issue additional debt in the future. Longer term debt has a lower annual payment, and it has less impact on your budget requirements. So those two things kind of get weighed in line with one another. And we do have some information on that, kind of looking at some of your ratios and cash flows that may be helpful to that.
But you pay more interest on long-term debt, right?
Yes, sir. The longer the debt's outstanding, you do pay more interest on it. Yes, sir.
You good, Mr. Belfield? Go ahead, Mitch.
Okay. So looking at these two key categories that influence, that you all have direct influence over, first, we wanted to look at the general fund budget performance over the last 5 years and the general fund balance. And this is on page 7 of your materials. And the top left graph, what we're looking at is with the gold line is your annual revenues coming in through the general fund budget. The two green bars, the dark green bar is operating expenses and the light green bar is debt service, represent your ongoing recurring expenses. And then we do have capital and transfers out largely to capital funds layered in on top of that. And what we see is that gold line is above the green bars each of the last 5 years. That indicates that you have a structurally balanced budget. Your annual revenues coming in are covering your annual expenses, And in years where you don't invest in heavily in capital projects, you've been able to add to fund balance, which you can see on the bottom graph here is how the fund balance has evolved over the years. And outside of fiscal year 2023, when you chose to invest some of that built-up fund balance in capital projects, you've been able to add to fund balance every year other than fiscal year 23. And that has set you all up nicely, as we've looked at over the years, to be able to start to address and invest in future capital projects. And you all have adopted a fund balance policy related to this general fund balance, and that's on the next page, on page 8. And your fund balance is sets a minimum unassigned general fund balance. So unassigned is a accounting terminology, but it's basically your bottom bucket of fund balance, your rainy day funds. You can use those for any available purpose if you needed to. There's no outside restrictions on those dollars. That's a minimum of 20% of that unassigned fund balance that you have to maintain. And then as part of your policy, and this is in line with GFOA best practices, you all have further clarified that any fund balance in excess of that 20%, any unassigned fund balance in excess of 20%, may be used, drawn down, for non-recurring expenditures, which is typically capital projects. And I think that's an important and very positive part of the policy because of the fact that fund balance is a non-recurring revenue source, right? You have to build up the fund balance but to the levels that it's at, but once you spend it, you're not necessarily replacing it the next year. You can't count on that being available every year. Once you spend it, it's gone. So tying that sort of finite, one-time available revenue to one-time expenses kind of ensures that going back, you can maintain this structurally balanced budget. Your annual revenues will still be able to cover your annual expenditures. So in the chart in the upper right graph, we've kind of tracked this policy going back 5 years. And you all did, I think it was 21 and 22, had a 15% policy and adjusted that upwards to the 20%, more in line with where you'd been historically. And you all have been in compliance with that policy each of the last 5 years. In 23, when you invested in capital, it did come down to your policy level, and then you replenished it again in fiscal year 2024. The bottom chart here, just thought this would be helpful perspective, and we looked at this in prior years, comparing you all to the averages of other rated counties, both nationally and within North Carolina. The national medians are in the light green bars, and that's the highest rated AAA, your category AA, and the category below you single A. Those are the light green bars. And then the dark green bars are those same rating categories, but for the counties in North Carolina that are rated. And you all are at the top here, this gold bar, just under 30%. And you can see you line up nicely to these medians nationally and in North Carolina, though you are not, you tend to trend slightly below that AA median in terms of a percentage of your expenditures, but you're not an outlier. You're kind of within a good range of that median, and you can see in North Carolina, these blue bars that are layered in on top show the maximum levels and the minimum levels that fall into each of these categories, right? So the minimum levels are around that 10 to 12% for some counties as the absolute low of those various rating categories. And you're well below those minimums at the 30%, and you would be above those minimums even if you spent it down more towards the policy limit. But hopefully this gives you some perspective. Even above your policy at the 30%, you're still slightly under those medians, but not an outlier. So in good shape on this ratio.
Mitch, looking at what you're saying here, we occasionally get questioned about the amount of fund balance that we have being on the high side. But yet, when I look at this, we really are not too high by any means.
Yes, sir, that's right. So just looking at the data, you know, you're certainly not an outlier on the high side. You can see there's some folks north of 50, 60, 80% of unassigned fund balance. And, you know, actually slightly below your rating median category.
That's a surprise to me, really. I'm glad you pointed that out.
Yes, sir.
Go ahead, Mitch.
Nope. I was just going to say, I think the other piece that may be helpful for you is just looking at the dollars, right? So on the left-hand side, putting that policy in terms of dollars, right? And this is based upon your last audit, fiscal year 24. Your general fund expenditures were right at $116 million. So your 20% policy would equate to $23.2 million, right? So that's the minimum dollars that you would have had to have in fiscal year 2024. You were at about $36 million, right? So that gave you a little bit of a cushion. That's where, you know, 2024 expenditures versus revenues, it's right around that 30%. And if you look at line 6 there, the differential between your absolute minimum dollars and where you were at is about $12 million. That's that piece as of fiscal year 24 that you would have to deploy for capital expenditures. Throughout the course of fiscal year 25, I think you all have taken advantage of some of that. With some property purchases that came available, you were able to appropriate that fund balance. And you've also set aside $2.5 million to go towards the senior center project that's been on the CIP, reduced the amount of debt you were issuing by funding that with cash. Okay? So that kind of leads us into where we are on the other piece that you have control over is the tax-supported debt. And as of June 30, 25, you had just over $50 million of tax-supported debt outstanding, and that debt has been issued to fund county, school, and community college projects over the years. All of your debt is paying off by fiscal year 2043. So less than 20 years, all of your debt will be paid off. All of your existing debt will be paid off. And you're paying it back in a responsible fashion. You know, you are retiring that debt at a healthy rate every year. And one of the ways we measure that is by the percentage of principal, so the percentage of that $50 million that you're paying back over the first 10 years. So from fiscal year 26 to fiscal year 35, you will have retired about 89% of your total debt outstanding. That is a very good level to be at in terms of what we refer to as the 10-year payout ratio. And this is a ratio that you all do not have a policy on. Others do have policies. It's kind of hit or miss, but it is a common policy. And the typical policy range we see is in that 50 to 60% minimum 10-year payout ratio policy. So just, I'd mention that for perspective, that at the 89%, you are well above any typical policy levels that we see, in very good shape. And again, indicating that you all are paying back your debt responsibly. You know, while some of it, Mr. Belleville, is long-term debt, you are retiring it at a rapid pace. So that's kind of blends down the short term and the long term. You all have adopted 3 debt financial policies, and we've summarized those for you on page 11. debt to assessed value, which is your debt outstanding as a percentage of your tax base, debt service to expenditures, which is your annual debt service payments as a percentage of your budget, and your debt per capita, which is your total debt outstanding divided by the county's population. And regardless of which ratio we look at, you are well below your policy limits at this point. These policies are maximum levels. You're well below those policy limits. Similarly, like we did for fund balance, we compared you to these rating medians at the bottom of the page. Same setup. I know it's a little smaller, maybe harder to read the text, but same setup with Nash County in gold, National in light green, and North Carolina in dark green. And what you see is, regardless of measure, you are in line or below these rated medians. So well below your policies, below the other rated peer medians. You all have managed your debt profile effectively over the years. And this would indicate that you would have debt capacity under these ratios in the future. It is under your financial policies that are adopted. It is reasonable to consider debt as a tool to fund the capital improvement plan going forward. The related question to that debt capacity is oftentimes the more important and restrictive one is what we refer to as affordability, right? What is the room you have within your budget to take on those new debt service payments?
Davis?
So when you look at it per capita, our limit is $1,000. What does this say it is presently?
So you're just under $500 per capita. If you look, Mr. Davis, in the middle section, that first bullet, existing debt per capita, $496.
Right. This past Saturday, I had occasion to hear the state auditor speak. If my memory serves me right, he indicated that the state debt equal to $49 per capita, but yet indicated that the federal debt was in excess of $100,000 per capita. So compared to those, I don't know what to think really. Considerably more than the state, but I think everybody at the table for being not anywhere near the federal, but that just puts perspective of where we are.
Yes, sir, and I think that's where, you know, we do try to compare you to other peers, right, who have similar responsibilities. So, you know, national, you lose a little bit of that comparability. Places like South Carolina, Pennsylvania have independent school districts, right? They don't have to take on their school debt. So the national medians tend to be a little bit lower than the North Carolina medians, but yet you still stack up nicely to those national medians as well. So, point taken, understood. I think by narrowing it down to folks who have similar responsibilities and doing that comparison, hopefully provides a little bit of perspective to that.
You good? Go ahead, Mitch.
Yes, sir. So the next couple pages get into that question of affordability, impact on your budget. And we do look at this separately for both schools and county, because schools have restricted revenue sources that can only be spent on school capital projects. I won't walk through this chart. I know I've done it in past years. I just kind of hit the highlights here. Columns B through F are what we're calling your funding requirements. And on this page, we're just looking at the existing debt that you all have committed to pay. That is your existing school debt service. And columns G through J are looking at the revenues that are available to pay for school debt service and capital, restricted school sales tax, and lottery funds. And what we see is that the total revenues available in column J are higher than your total school debt service requirements in column F, so you have these annual surpluses in column K. That is what is building up and creating your affordability to fund school capital in the future. and as we look to fund the capital improvement plan and the annual school pay-as-you-go capital allocations, those dollars in column K are what will be used to cover that. I do want to note, column L, the school capital reserve is starting out at $4 million. That is the county contribution to the middle school that you all have set aside to match the grant funding that you've received. So that piece is already covered. You've already set that aside. Okay? Similar setup on the county side. B through E and under the green bar are the funding requirements. And again, starting out, just looking at the existing debt service that you're committed to pay for county and community college related projects. Underneath the brown tan bar is the revenues that are available. And this is consistent with what we've talked about in recent years. You all have done a nice job of establishing dollars set aside to address debt service and capital. And so you've got some fixed contributions there between the general fund transfer or set aside and the Article 46 restricted sales tax that's set aside, as well as the dollars that you all have been able to commit over the years for pay-as-you-go capital. And I will point out column H, we are assuming that there will be $1.5 million available for pay-as-you-go capital projects every year. And what that represents is a combination of annual surpluses, excess over your general fund balance policy. So we know you're starting out in compliance with your general fund balance policy. We looked at that previously. And the general expectation that, with conservative budgets and growth, you often outperform budgets when the audit is complete. So between your existing fund balance and potential future budget surpluses is assumed that you all will be able to make available $1.5 million every year to go towards like pay-as-you-go capital type projects. And that's wanting to account for the likelihood of those dollars being available and not having to issue more debt to fund capital projects when you would likely have cash available. That's something that would be monitored every year and revisited for its appropriateness. Okay? So specifically looking at fiscal year 26, page 15 of your book lays out the capital projects that are being considered for funding and the related funding sources for those projects. And I'm sure staff has talked to you all about these and will be talking to you all about these. I won't go line item by line item unless you all have specific questions, but there is a mix of grant funding, pay-as-you-go capital funding, and debt funding that's been identified. And total on the county side, lines 1 through 12 are county and community college projects. That's a total of $21.6 million in fiscal year 26 that has been identified for funding. And there is $1 million of grants coming in to offset that. There's $7.6 million of pay-as-you-go capital identified. So that is largely the use of some of that excess general fund balance that you all have built up over the years for things like the senior center, which is reducing the amount of debt that we're projecting for issuance to fund these capital projects. The remainder, a little over half, about $13 million, has been identified for debt financing. And this financing has been identified over the last several years as part of the CIP process. And with some of the performance that you've seen in recent years has come down. Last year when we spoke, we were looking at a $17.6 million financing for both counties and schools. Now we're just looking at financing on the county side of just under $13 million. So reducing the amount of debt because of the past year's financial performance.
Mr. Belfield?
Grant funding, going into your budget, you only put in there exactly what you know, the grants that you know you're gonna get, or do you have applied for some, but you're not sure?
Yes, sir.
You don't add that into your budget, do you?
No, yes, sir. Great question. So the county has been awarded the $500,000 grant for the senior center. That has been awarded, so we're counting on that. Related to the Nash Recreation Center, the county's applied for 2 grants for that. A Part F grant, which is for parks and recreation projects, and an accessibility grant. What we're counting on, each of those is, call it 500,000. The accessibility grant is like 500,000 and change. But what we were counting on, based upon conversations with staff, is one of those grants coming in. So to your point, don't want to count on every last dollar because we have to be awarded, but the accessibility grant is anticipated to go through their funding cycle and make their awards by June of this year. So, hopefully before the end of this fiscal year, you will know on that project. And so we have counted on one of those 2 grants. And if you get both grants, that would improve these results.
Okay.
Okay. And then we do have the school funding down here on lines 15 to 17. And that is largely with the middle school project. You've got the $40 million grant, which has been awarded, and the county match of $4 million, which, remember, I indicated that you had already set aside. And then the annual sort of recurring pay-go allocation for the schools of $1,396,000. So what we're going to look at going forward is funding this capital program as it's laid out on this page, and we will also allow for an annual allocation for a community college pay-as-you-go capital of $290,000, county pay-as-you-go capital of $1,500,000, which lines up with that revenue source that we talked about, and school pay-go allocations of $1,396,000. So we know there's going to be continued annual recurring capital that we want to count on. We don't want to lose sight of that in the projections, so we factor that in.
Mr. Davis?
It appears like to me, item 16, school pay-as-you-go, may well be included in item 11. And if not, I hope we see later what item 11 is. Do you think 16 is in the figure for 11?
No, sir. Those are separate. The schools is specific to school capital, and I'll let staff jump in here. But I think item 11 is additional sort of shorter-term, smaller capital projects that have been deferred over the years that there may be an opportunity to address in fiscal 26.
Yes, sir, those will be items on the CIP that Mr. Boone will go over.
That we're going to see later?
Yes.
Okay, thank you.
Go ahead, Mitch.
Yes, sir. So using this capital plan, we layer in the assumed $13 million financing and revisit your debt ratios. And what we see is, as expected, you have the capacity within your policies to take on this amount of debt. We have assumed a 20-year financing at a 5% interest rate. We've gotten some recent bank rates and indications in more of like the mid 4.75 range. So there's a little bit of cushion in this 5% interest rate today for planning purposes. And then we further layer that into these affordability cash flows. The schools with the pay-as-you-go capital have ample capacity, affordability to take on those future pay-as-you-go capital funding needs. And on the county side, when we layer in the proposed debt service in column C and the proposed pay-as-you-go capital for fiscal year '26 and the recurring annual capital for the county and community colleges compared to the existing revenue sources, we do see the need for some additional revenues in a 4-year period of time from roughly 2029 to fiscal 2033. I will note here as well, column G, we are using some of that excess general fund balance over your policy to reduce the amount of debt that's being issued. So pulling in the dollars that have been set aside for the senior center, for example, and to address some of those additional shorter-term capital projects that staff will review with you all. And for perspective, last year when we looked at this, again, we had the slightly higher debt financing. We were projecting that there was going to be additional revenue needed of about $13.3 million. So with the performance and some changes to the capital projects that have occurred, the use of general fund balance being available, this has come down some from 13.3 to about $2.4 million. And it's occurring, several years from now. So don't need to come up with these additional dollars again till starting out in fiscal year '29, and on average it's a little over $500,000 a year that you would need to come up with. And looking at the fact that there's future pay-as-you-go capital and debt service is driving these needs, that could be a use of any built-up general fund balance over your policy. If that existed and you chose to use that, that could be one source to help close this gap or need for additional revenues.
Mr. Davis?
Mitch, when we go to the market for this debt, will we look at more than the 20-year, will we look at the 10-year rate and the 15-year rate at the same time?
Yes, sir. We would, like we've done in the past, we would typically ask for multiple terms of the debt. Typically for these type of longer term assets, it would be 15 or 20 years, but certainly could ask for 10 years if that board would like to see that as well. And the goal there is to understand what the differential in interest rates is, as well as the differential in payments, right? So, if we were, this is based upon the 20-year, if we were to look at a shorter loan, you're going to pay back principal more quickly, which is generally positive, but it will push these payments in column C higher in the earlier years and drive the need for additional revenues more quickly. The question will be, one of the considerations will be, is the benefit in the reduced interest, and do you get a lower interest rate with that shorter term? Does that offset in y'all's determination? Does that offset the additional revenues that would be required more quickly? So we will do that, yes, sir. We'll ask for 10, 15, and 20 years if y'all would like to see that. And as part of the process, we can revisit this forecast and show you what that looks like.
I would certainly think the board would want to do that, and then we're looking at real numbers and what we're doing moving forward. 'Cause I, as one commissioner, don't have any interest in borrowing money for 20 years. I'd much rather do it sooner than that, but if we get the numbers, then it can be a board decision, and we will all understand it.
Yes, sir. Understood.
Okay.
And I think the other thing that you may look at with that, and I was going to point out regardless here, is that this is just looking at the fiscal year '26 projects, right? So I know y'all are working on the CIP and determining priorities and desires to fund projects in the future. Any additional project funding is likely to require additional revenues over and above that of what is needed to fund the '26 projects.
debt analysis be provided before we have another session so we can kind of evaluate that, look at it? What he's talking about?
Are you asking for the financing piece?
Yes.
So that's something that we have to go out for,
You'd
with the
have to
banks.
check that.
Yeah.
Okay. When could we get that?
He's, getting ready to go through the calendar with
Okay.
you to show
All right.
you, the next steps that we need to
Well,
go
I would
through.
tend to agree. 10-year might be better, but we'll see.
Yeah, and we can certainly run this at the planning rates at the 10 and 15 year as well, and send that ahead of time, but we won't know what the actual, what the actual interest rates are until we go through the process. And that process will kick off towards the end of May. We'll send out a direct bank loan to all potential lenders and request their responses back in mid-June. For any projects like these, any financings like these, you will have to have approval of the local government commission. So we'll go through that process, and application will be submitted by the 1st of July. And then we would come to you all at your meeting on July 7th. This is subject to change, calendars change, but this is the current plan. Come to you at your meeting on July 7th, where we would have those bank proposals in hand and analyzed and be able to summarize those for you. And you all would need to hold a public hearing as part of the process. And then we would be looking for you all to consider adoption of the preliminary findings resolution. These two items, the public hearing and the findings resolution, are required as part of the LGC's application process. And then we would come back to you all, if you choose to move forward at that time, we would come back to you all with a final resolution that would be your final approval of the financing, that would include the terms and conditions of the proposal and financing term that you selected. Go to the local government commission for approval in August, and then have the funding in hand in that mid-August timeframe.
Go ahead, Commissioner Davis.
Commissioner, I know you're aware that we're used to borrowing money at 2% or less.
Yes, sir.
Can Davenport this morning tell us when we will see those times again?
Ted was here, he has the crystal ball, but, I think looking back historically, those were very rare times. And we saw that 5 to 7 year period of time where we had a very low interest rate level. And if you look back 20, 25 years at municipal rates, those were half of what the normalized municipal rates would be. So unfortunately, I don't know. I might not be here this morning if I did, but I don't think we should count on seeing those levels again in the near term, and be pleasantly surprised if we do. But where we are, call it 4.5% to 5%, is right on top of the historical averages of where it's been. So while it feels like we're higher, because of what we've seen in these sort of depressed interest rate levels over the last 5 to 7 years, we're really just kind of back to a normalized environment. And so it's kind of what we plan for with that 5% interest rate that we use for planning purposes. And, hopefully we can improve upon that. But, as well or better than most, that it's just market dependent, and don't foresee us being in the 2% range anytime in the near future.
You gave us the answer I expected you to give. When we go out to this, would you make certain that all of our banks that have facilities in our county are well aware of this?
Yes, sir, absolutely. That's something that we try to be very diligent about as part of the process. We'll coordinate with staff and make sure that we've got the right banks, but also if there's local contacts, we'll make sure to get the local contacts as well. I think we've got most of the banks in North Carolina covered, but it's not always the local contacts. Yes, sir.
Any other question? Go ahead, Mitch.
That's it,
You
Mr.
have a
Chair.
question, Mr. Belfield?
It's not a question, I was just gonna make a comment following Commissioner Davis's, that the policies and things that are going on now, I don't think we'll see 2%, and they're saying that things are gonna be set now. It's gonna be very difficult to change it in the next 30 to 50 years. And so I don't see 2%. Now, it's gonna be good if it's 5.
Yeah, I'm not sure anybody really foresaw 2%, and nor did we foresee it lasting for as long as it did. So I think very, very fair observation.
Anything else, Mitch?
No, sir, that's all I got.
Just one quick question. I may have overlooked this when we were going through this, but in this analysis, and was there any consideration or anything put in there as far as the percent of increase in growth in the county? Did I overlook that?
No, sir, you didn't overlook that. In the debt to assessed value calculations, we do build in growth of 2%. For the debt to assessed value and debt service to expenditures and debt per capita calculations. We have not built in any growth in the sales tax on the school side or the county side in terms of the revenues, because that is a very volatile revenue source, right? So we try to be conservative, and to the extent you overperform, hopefully that falls to the unassigned general fund balance, and then you've got those dollars that you can apply to pay-as-you-go capital. But otherwise, that's really the only revenue sources that are tied to a specific revenue stream. Otherwise, on the general fund, the other large funding component is just the annual transfer, which has historically been a fixed amount. So it's not tied to any percentage of your tax rate or percentage of your tax base being applied or set aside for debt service. It's just a fixed amount.
So the 2% is for inflation increase with expenditures?
Yeah, yes, sir. The assumption is if your tax base is going to grow at 2%, then your budget, it may grow at 2% as well. It's just seems like a reasonable assumption outside of any very specific budget forecast.
Thank you.
Yes, sir.
Any other questions, Commissioner Davis?
One more thing that, Freddie and I heard on Saturday from the state auditor is, when you're looking at growth in a county, he indicated that we should not expect any growth in revenue from residential construction, that it actually brought additional costs with it, and at best, we may break even. Whereas we had to depend on industrial and creating total assessed value on the industrial growth, which is where we gain additional revenue. Do you have a comment on that statement?
I think it's, I think it's dependent upon every circumstance, but overall, I think it's a very reasonable observation, right? And when you think about residential, it comes with services, right? I mean, the bulk of the services that you provide are to residents, not necessarily industries as much. So, more people, more sheriff's deputies, more planning office to process new homes coming in, kind of affects all aspects of county services. So I would say the revenues do increase, right? But the expenses likely increase as well, so the net impact isn't as great, right? So a lot of times you see big growth in assessed value and growth in revenue budgets, and you think, oh, we can cover everything from growth, but the operating expense side tends to grow as well, and that operating expense side often occurs before the capital side, right? So more people moving into town, more student-age population, more needs for school infrastructure. It is kind of impacts all aspects. So I think comparing the two, industrial and commercial growth generates, generally speaking, more net revenue than would residential growth. But very, very specific, right? It depends upon the infrastructure that you have and how much capacity do you have in your infrastructure and how much capacity do you have in your staffing levels. There may be a certain number of new residential units that you can take on with greater margins, and then once you hit a certain level, those margins shrink. You kind of have to evaluate that on an individual basis.
I feel like in Nash, we are probably at the limit of what we can take on without additional expenses, and he put the emphasis more on schools than anything else, and the school funding model in North Carolina.
Yeah, I think a lot of people are struggling with that, for sure, with the need for schools, and that's a very common conversation around the state that we're seeing.
Any other questions? Mitch, if you want to hang around, we're going to have lunch about 11:30. We'd love for you to stay and have lunch with us, if your schedule would permit it.
I greatly appreciate that. We actually have a client in the market today, so I got to hop over and get into that. But I'll definitely take you up on it next year if I'm invited back.
Well, thank you for the presentation. Commissioner Harrington?
Well, first I want to thank you for a fine, thorough report that you gave us. I thank the county manager and our staff for doing a fine job as your report as presented. And also the rating where we're at now at the AA2, as I think you explained before, that moving up in that rating really doesn't do a whole lot, but that we are very comfortable at the rating that we are presently at.
I mean, I think that's a very fair statement. I think in the AA category, particularly, AA2 and above, where you're at, that's a very strong credit rating. The incremental benefit that you see in terms of rates between, a AA2 and a AAA rated county isn't that much in the big picture, right? I mean, other benefits are being a AAA county and perception, and when you talk to lenders, does that help with perception-wise, more people being interested? Those are more qualitative, hard to judge. But when you look at sort of interest rate comparisons between a AAA and a AA2, the differential varies over time and in different markets, but the average that we typically think about is in that 0.05 to 0.1%. So I don't think in terms of affordability of debt, it has that major of an impact. Once you start getting below your current rating level, you do start to see some things widening out a little bit more. So I think where you're at is a very strong level. Obviously, higher is nicer, but I don't think it has that major of an impact on the cash flows.
Seems like it give us more leverage.
Yes, sir.
All right, thank you.
Other comments? Thank you, Mitch. Very good presentation.
Thank you. Thank you all for having me back.
Thank you.
Okay, we're going to take a 5-minute break now, and as we go through the day, if you need a break at any time, just let me know, and we'll be glad to stop and accommodate, okay? All right, Mr. Boone, recommended CIP, you're up. You're going to go through the one-time purchases in the budget and then the total fund balance associated with non-recurring expenses. Is that the two items you're going to be going through?
Yes, sir.
Okay. You got it.
All right, so Mitch had a lot of numbers and spreadsheets, and for those of you who know me, know I love numbers and spreadsheets. I'm gonna go a little lighter on you, with this particular item, but we're all gonna talk about a few numbers, and, as you see, I would like to talk about CIP first, and then we'll talk about the, non-reoccurring expenses in the, operating fund. But as you recall, in our small group meetings, we had shared with you the list of capital projects that we had compiled with the assistance of our departments. As you recall, the 4 different sheets that we have provided you. The first grouping were general CIP requests from each of the departments. There were about 61 of those, as I recall. Then there was another set of projects that were really projects that didn't require funding from the general fund, more enterprise funds or separate funding sources. And then the fourth sheet was a project basically that Mitch reviewed for you in his presentation. But the group I want to focus on is that first two sheets. You may recall there's about 61 projects. So typically when we think of capital projects, we think of physical assets, and they're typically related to assets that we can depreciate, and the threshold that we use here at Nash County is $5,000. And those 61 projects, plus minus, you recall, totaled $4.8 million or $4,754,047. And we are continuing to work on that list, but where we stand today and what I'm here to share with you today is we currently have identified projects totaling $3,549,545 for funding in the FY26 budget. But again, that's something we'll continue to work on, and certainly interested in your feedback today along those lines. But as the chairman kind of alluded to with this presentation, at this stage in budget development, the assumption we've made is that we would use some of that excess fund balance to fund these items. So I've got the entire list, and we can go through that list if there's an interest in doing that, but what I thought I'd do first is just focus on the bigger items in those that 61 requests that we received. And by and large, the biggest one was a request for vehicles. 9 departments submitted requests for 30 vehicles. And at this point, we have identified 26 of those vehicles to be funded in the FY26 budget cycle. And the remaining 4 vehicles, we would propose to reassign a vehicle that's being replaced. And I'll talk about that a little bit more in a minute to the department that requested a vehicle. So right now, we've identified funding need for 26 vehicles. And of those 26, 15 are within public safety. That includes 10 for the sheriff's office, 9 for patrol, 1 for the detention center, 4 vehicles in EMS, 2 of those vehicles being ambulance replacements, 2 of those being QRVs, and then we have 1 vehicle for emergency management and fire. I mentioned, again, on that third sheet, the CIP requests, some of the vehicles have been requested would be funded with a funding stream that would not rely on the general fund. So the example I would give you, our inspection department collects permit fees. We accrue those funds over time, and in this budget, we're proposing to replace those 4 vehicles and use funds that we have accrued over the past few years through those permit fees. And actually, 4 of those vehicles will be ones that I mentioned we would reassign. We'd reassign those vehicles to existing departments internally as they replace those vehicles in that department. But you can see that accounts for $283,070 in vehicle purchases. So the overall number, you see $1,458,731, but if we subtract the vehicles funded with funds outside of fund balance, the actual fund balance appropriation will be $1,175,661. Any questions about that? Yes, sir.
Commissioner Howell?
Comment, can I get an actual full copy of that, not this time, but at a later time,
Of
of the full breakout of all the vehicles that
Okay.
were requested?
it's in your slide, but it may be kind of hard to follow, but yes, I can get you the 11 by
Yes, sir.
17.
Thank you.
No problem. All right, so the next project I wanted to just highlight, again, is currently recommended for funding in the FY26 budget. You know, we've gone through a couple of phases with security improvements there at the administration building. About 4 years ago, we had looked at additional security improvements again, in the admin building. And in the FY26 budget, we're proposing to move forward with 2 additional locations on the second floor, and that would be in the tax office and the planning department. And this is a schematic that was developed at the time for the planning department, and this is for the tax office in the listings area. You know, where you go for payment, they already have a kind of a lobby there, a secured lobby. So both those projects together, it's not $235 apiece. Both of those, the budget estimate is $235,000. Next item we have is from MIS, our phone system. Our current phone system is about 10 years old. It's to the point that we cannot get replacement parts for the system. Maintenance is also very expensive. We actually currently do not have a maintenance contract with our phone system. It is well beyond its useful life, and MIS department is recommending that we move forward with replacing that system with a next generation voice over IP system. And you can see the budget here for that item is $228,000. We'll mention that the transition to this system, Sandy had reported, we have 4 high-capacity lines, PRI lines, if that means anything to anybody. 4 PRI lines that come into the building now to support the current system. The new system will be able to do away with those lines. That would save us about $3,500 a month. So there are some cost savings that go along with upgrading our phone system and our technology. But this is a much-needed project for the county. Any questions? All right, next item we have is computer replacements. MIS department has requested $100,000 for computer replacements in FY26. And depending on whether those are laptops or desktops, that would be anywhere from 56 to 84 units next fiscal year. After computer replacements, we have portable radio replacements in the sheriff's office, and this will be a multi-year project, but this is our first year of that project. They've requested funding for 25 portable radio replacements. These would be Viper compliant radios, and those radios would cost budget $152,000. We also have the need to replace some of the equipment both at our 2 dispatch centers and our radio towers, radio sites, which we have 6. Again, we've got some equipment that's reached end of useful life, and 911 Communications is proposing to replace that equipment in the next budget year. That totals $197,150,000. And this equipment primarily supports our paging system, which not only supports the county, but also our volunteer fire departments. And then the next item I have, the EMS department had requested funding to equip our existing ambulances. So as we buy new ambulances, they're equipped with this technology. We have some existing ambulances in the fleet do not have the power stretchers. We have 10 of those, and we were looking to fund 5 of those stretchers in the FY26 budget cycle and 5 of those stretchers in the FY27. But we're here to talk about fiscal year 26 today. The only change I did not have time to make to this slide, working with grants, there was some coronavirus funds that the county had received, and we are reallocating to the EMS department. So actually 4 of the 5 power stretchers, it looks like we will be able to fund with those coronavirus funds being reassigned. So actually I need to reduce this number. The cost to the general fund will be $56,400.
Mr. Leggett?
Got a question, if you don't mind.
Yes, ma'am.
Would this complete the power stretcher upgrades for all ambulances, or did you say that this is only 5 out of 10?
This is 5 out of 10. So we do the next 5 in FY27.
But you said that we had money to cover 4.
Correct. So that would allow us to only have to pay for 1 out of general fund this year. I mean, if there was a desire, we could fund 5 out of general fund this year, take the 4 from the grant and fund 9, or go ahead and fund all 6 and rely on the 4 from coronavirus funds and do them all in 1 year. When we initially were looking at this, it was before we realized we were going to have the coronavirus funds available, so we had busted it up 5 and 5. But certainly, if there's a desire to accelerate that project, we'll find a way to make that happen.
Okay, if the funds are there, I certainly would have the interest in doing so. I understand that there's, a number of back issues with our EMS employees, and workers' comp issues frequently come up there in that area. So I think that this would be a good use of funds.
Understood.
Thank you.
Mr. Davis?
These things are really $60,000 a piece.
$56,400.
I agree with what Sue said.
Mr. Howell?
So, I know we got some new ambulances coming in, and new ambulances do come equipped with these, but how many do we have currently?
how many of the power stretchers do we have?
Currently?
You're gonna put me on the spot.
Is it
I
3
think
or
it's- I actually thought it was either 5 or 6. Because I think we have 20 ambulances with frontline and reserve. But we can confirm that with Dale Griffin and/or Travis should be joining us for lunch. But I think we have 5 or 6 currently in service. We're expecting another ambulance next month. That would be equipped with a stretcher, so that would add an additional one. But I think it's either 5 or 6 currently. And that's because they were added to the ambulances when we bought them. So they were not retrofits. The ones we're talking about here obviously are retrofits. And I will say, since I mentioned retrofits, there is some nominal cost for the retrofit, but I want to say it was like $1,500, $2,000. So a bulk of the expense is in this lifting equipment. So we could take that and we could use that on a new vehicle. So it's not like we're investing a lot of money that we'll lose on the existing ambulances. It's a nominal cost to upgrade them, and then these units can be transferred to a new unit when it comes online.
Thank you. I'd just like to echo what Robbie and Sue said as well. If we could go ahead and find a way to make this work, because I think it's going to save us money in the claims on our employees and make them be able to operate safer.
So today, when we go through all these items and there are recommendations from the board to increase or whatever, when are we going to look at these changes and see what the total impact is? Would that be at our May meeting or?
At the May meeting, that's when we will be providing a recommended budget, and, but between now and then, we can communicate with the board what we've done to make adjustments to that. I've just received a text from Dale that we have 4 of those in service, and 3 that are on order.
Thought you said we weren't live.
Pardon me?
Thought you said we weren't live.
We're not. I'm live though, and my live self texted him.
Mr. Chairman, that probably time.
Let me finish my thought. So as we go through this today, and there are recommended changes, then you're going to summarize those recommended changes, provide them to the board in advance of our next meeting so we can all consider those changes?
I can do that, yes.
Okay, would that be what the board would like to see? Okay, thank you, appreciate it. Commissioner Davis?
Mr. Boone, this is a lot of expense. What is the life expectancy for these? Or are we gonna start hearing they're out of their useful life like we do many things? And should we consider possibly leasing rather than buying?
That is a good question. I have not posed a lease option to Dale, but I will say we do have maintenance contracts on it because it's a specialized piece of equipment.
Right.
We want to make sure that it's operating correctly. I want to say we certainly expect a 10 to 15 year life out of these stretchers. But again, we do have a maintenance contract in order to extend their useful life. If there's a lease option or not, I'm not aware of that. Wouldn't be surprised if there is, and certainly that's something we can explore, right, and get an answer to your question.
But the life expectancy you think may be as much as 15 years, which is not so bad, but
Right.
a lot of things we do, it ends up being 4 or 5 years.
Right.
Yeah, I just want to be clear on those recommended changes too. That would be recommendations from the board. They would be sent to us, we would consider them, but that doesn't necessarily mean that the board would approve them. We could, we may not.
Sure.
Okay, just want to be clear on that.
And may I say, when we do a recommended budget at the May meeting, you all will have an opportunity to let us know before then, but also at that moment.
I don't want to prevent any commissioner from making recommendations today, and then that can be provided to the board for consideration, and we'll look at it in the big picture going forward.
May I add one more?
Yes, ma'am.
And I did get confirmation from Dale that a 10 to 15 year life on those.
I mean, it's a real-time fact checking here today.
Where you meet?
Jonathan?
Yes, sir.
So just to add to that, I know it's an initial expense we're looking at considering now, but as we continue to reorder new ambulances, to the fact that they have a 50-year life expectancy, we can order the new ambulances without them and reuse the current ones.
We
So
actually
it puts our
provide these,
replacement
we
cost down.
provide these to the upfitter to install. Yes, ma'am.
I guess to Commissioner Howell's point is also when these start aging out, when we purchase new ambulances, we can purchase them with this equipment installed. So it would basically be included in the price of the ambulance once the need arises to start replacing these units.
We include it as part of the project, but I believe the way it works is we order the ambulance, and just like with a QRV, then we send it to an upfitter. So a lot of these things we'll go ahead and order, so there's no markup on them. We try to minimize the markup, and then we will provide the equipment to the upfitter to install. So that would not come from the manufacturer of that equipment.
Okay, thank you for that clarification.
And the other thing, just to expound on the comment from the chairman, and I think the manager and I are on the same page with this. I mean, we're looking for feedback today to help us. We've still got some ground to cover. You're going to hear about that today. We do not have a balanced budget as we stand here today. So we're looking for your feedback to help us as she continues her efforts to get ready for that May presentation. But as I alluded to in the early part of this presentation, the current thought is we would rely on a fund balance appropriation to fund CIP. So for example, if we were to accelerate those additional 5 stretchers, the manager's going to need to find another $282,000, and right now the thought would be to rely on that additional fund balance that Mitch referred to during his presentation to help fund that project. Okay.
Understood.
All right, and then the final item that I was going to share with you today is, and you may remember again from small group meetings, EMS department has identified the need for the next EMS station to be constructed somewhere between Nashville and Rocky Mount due to call volume. And most of you will probably remember the last EMS station we built was in Nashville. That was about 7 years ago. And based on data that Dale and Travis were able to compile in terms of call volume in the last 4 years has increased over 50%. And where our need is in kind of on that boundary between Nashville and Rocky Mount. The county does own some land adjacent to the community college. That would be one site that we'd certainly look at as a possible location. But we have requested funding or proposing funding in the FY26 budget cycle for the planning and design to construct that station in FY27. So that is also in the current budget proposal.
Does that, Jonathan, does that spot where you're talking about next to the Pet Connection Center, is that the ideal location for the increased traffic with EMS?
I think
or is there a better?
In talking with Dale and Travis, it is because of the call volume and the anticipated development with Project 336 and other development going on the west side of Rocky Mount.
Okay. So it wouldn't be.
The location is also helpful in terms it has close proximity to US 64.
Okay.
So a major corridor to respond to calls. But yes, that's a location that they felt like would where we need those resources.
Mr. Lake.
I see the photo, Station 200 in our slide, and, you know, if this is proposed to be built on county property, I wonder if one thing that could be considered in the planning process is having a station that would be expandable as future needs unfold, that there would be that potential to expand the station and not just a, you know, set design that's all you have.
Yeah, I really just provide this picture because that's the most recent station we built, not that we would replicate this same station at that location. The budget number you'll see in FY27, which would be theoretically the year of construction, was based on a 5,000 square foot building. This is about a 3,600 square foot building. But, you know, as we go through the design and planning process, we'll work through some of those issues. But didn't want you to think this picture means that this is what they're proposing to build. That's just the most recent station that's been constructed.
Thank you.
Mr. Chairman,
Mr. Davis.
moving forward, I'd certainly like to see you consider the method of delivery that we used on this station. And, thinking we could save quite a bit of money, particularly the $200,000 that you got set aside at this point in time. Thank you.
Go ahead, John.
All right. So again, if there were questions about specific projects, I've got the individual line items. But in the interest of time, I wanted to mention again, if you recall, I talked about that third sheet from that list of projects that you had. Just want to touch base on those projects that, again, are recommended for funding, did not have an impact on the general fund. But again, we're proposing to use reserve funds in planning and inspections. And then the health department also has funds that they have allocated for vehicle replacements. That accounts for 7 vehicles next fiscal year. Emergency Communications also has projects that they are requesting for next fiscal year. I believe there were 4 of those. Those will be funded with the charges that are applied on cell phone bills, other bills that the state collects, and is remanded back to the county. So again, no impact on general fund, but you can see console furniture and headsets replacements. Public Utilities Enterprise Fund, we have 3 projects there totaling $130,000, and then solid waste, which you will be hearing more about here in a minute, and may recall our discussion at the small group meetings. There are 5 different projects there totaling $330,000, but again, no impact on the general fund for these projects. All right, so we alluded to also one of the things that we looked at as part of our work on the budget is looking at our operational budget. So we talked about the criteria we use for capital projects being typically physical assets that are depreciated more than $5,000. But we also looked at our operational budget for items that would be one-time expenses, so would almost be like a capital project, but would not meet that criteria or our current criteria, but again, will be one-time expenses that we might consider for funding with a fund balance appropriation. And I've got some examples here. New software has a one-time setup fee, and I've got an example of that for you. There's some small appliances that the detention center is requesting in next fiscal year. There's some items at the parks, benches, goals, things of that nature, youth sports equipment. Professional services, human resources as a project that they're proposing for FY26 to digitize a lot of the records that we currently have in paper format, office furniture, equipment, things of that nature are items that we identified. And currently we've identified about $493,910 across 9 different departments in the FY26 budget. And again, we're proposing that we would use fund balance appropriation to cover these expenses and help balance the budget for FY26. And you have a handout. I believe the manager provides you a handout. It may be a little bit easier to read. I basically have broken that into 2 pieces here, but again, you can see some of those projects. I mentioned setup fees. So the Sheriff's Office has requested a new application that they could use for community outreach and engagement. And also to send emergency alerts, things of that nature, the one-time setup fee of $14,000. And again, I'm not going to go through all of these, just hit some examples. Detention center, you can see there's some small kitchen appliances. Parks and Rec, I mentioned some of those elements. Trash cans, looking for sod cutter. Again, that's less than $5,000, it's $4,000, but it's a one-time expense. Some outdoor grills that need to be replaced, some mats for the zip line, and some mulch in its park. Recreation, some youth tackle, football equipment, helmets, pads, etc. Emergency management, they've got a couple of vehicles, one new request, one existing, where we need to put Nash County graphics on it. Yeah, so you've got the list in front of you. Any questions about any of those projects? The manager's holding up that sheet if you're having trouble finding it.
Commissioner Davis.
Boone, I look at what you're doing here, and I can't buy into the fact that what you're listing here is really capital projects. It looks like it's more ongoing maintenance to me. It appears like we're trying to utilize this to use fund balance by stating this one-time expenditures when it really is not one-time expenditures. I think it's a play with words in the way that the private sector looks at capital projects. Things of ongoing cost, these are going to be ongoing because there are certainly things, small appliances, things of that nature that is going to happen quite frequently. So it bothers me that we're utilizing this method like this, and I would just caution us to start to putting these type items as capital projects and spending fund balance on them because they're just not one-time expenditures, is my thought on what we're trying to do here. Thank you.
I guess my immediate response would be most of these items would not be items we'd expect to see every year. Again, no, they do not meet the criteria of a capital project. But I would also say that the county has used fund balance appropriation before to balance the budget. And certainly that was more than the capital budget. And what we've attempted to do is to just say, to use a number, we've tried to identify specific uses of those funds in the operational budget. So some justification for a number. We could use more, we could use less, but we did try to identify items that were not items that we would expect to see year over year. But, benches typically have a useful life for more than a year. Appliances, we hope we're gonna have a useful life for more than a year. Side cutter, used more than a year. I can't remember, Thomas is not here, the last time he said we bought youth football equipment. I know he's been asking several years, and we haven't funded it. But it was just on our part, some effort to identify specific uses of a fund balance appropriation. But, another approach could be just settle on a dollar amount, and that be applied towards balancing the budget and on the operational side.
I think the difference is probably just in the definition of ongoing maintenance. You seem to be utilizing a year, and in private sector, it's much longer than a year. But just my comment.
Right.
Thank you.
The 493 that's itemized here, that's the same as the 493 over here, right? What's the useful life of a vehicle in the sheriff's office?
I think they'd like to replace one every 5 years.
Okay. What would you think would be the useful life of a bench?
I'd like to think 15 plus years.
I mean, I think you've identified some things here that I think would qualify for capital, and we can look at them individually and make that decision, but I think this is a good use of the funds. That's just me. Commissioner Wilkins.
Question, under social services, the total is $206,075, county half $103,000. Are we not funding?
They have the grant funds, so the county only has to pick up about half the cost.
Okay.
If we want to take capital items and have some useful life on it and make some determination and set that in some kind of policy or understanding, I'm okay with that, but,
Well, again, it is a different approach than we've taken in the past. It was just an attempt, as opposed to just using a number to balance the operational budget, to have some justification for the number we are requesting.
Well, again,
or
I
proposing.
hadn't reviewed all these items, but the few that I can see look like they're pretty needed items and they're reasonable requests. Oh, I got a bigger one. Okay, thanks. All right, moving on.
In the absence of any additional questions about that, so just to summarize, so from the capital projects, that was the initial list of projects we reviewed. Current request is for $3,549,545, and that's where we currently sit today. But again, we are looking for feedback from the board. These one-time operational expenses or items in the operational budget that we've identified, $493,000, so that totals up to $4,040,455 in quote-unquote capital expenses for the FY26 budget. And again, as we stand today, our proposal will be use fund balance to cover those expenses. And that's my last slide.
Any other questions for John?
Jonathan, can you go back to the security enhancements? I'm having on page 13, I'm having a little trouble understanding what would be done there. I take it that the shaded area would be not added, but cordoned off?
If I can get my pointer to work. Basically, this is the main lobby on the second floor. This is the entrance to the planning department, and we'd create a lobby here with a secured access where you currently enter the space.
And the other one too is creating a lobby?
Basically, it's just creating, as you enter today, so you enter here, you've got two employees up front. We create a secured access here and walls and glass in front of each of those workstations. So it's not just direct access back into the space behind them.
Thank you.
Any other questions for John?
Comment.
Commissioner Davis?
I realize we're all concerned about safety, but I sure hope we look long and hard at making our citizens and taxpayers feel comfortable and not barred when they come into our building. Sometimes we might be a little bit too far, but just keep that thought in mind. I don't want to create an environment where the citizen doesn't feel comfortable coming to a county admin building and the individual departments.
I would hope that we would all agree that even with our enhancements at the front of our building, it has not been more welcoming than it is today with the staff that we have staffing that situation and being there to be a resource to every customer that comes through the door and give them direction and answer questions. And I just want to put a plug in for our staff, because I think they're going above and beyond and make our citizens feel very welcome.
My comment wasn't directed at the interest whatsoever. It was just a feel of walking into a department that makes
Right.
you feel like you're walking into part of the detention center, maybe.
Mr. Chairman,
Yeah, I would say that.
Well,
just a comment about that, and I'm sure Major Wilson over here can attest to it. You just never know when something may happen. When I was at IBM at East West Highway in Bethesda, you know, someone drove a vehicle right through the lobby in the other part, what we call the Rusty Bucket, and everybody had to go on lockdown because you don't know if it sets off, if they're working, if it's more than one, but to me, you just can never be too careful. So.
I would say the most recent addition, is the work we did in public utility facilities, and I think that's worked out really well. I'm not aware of any negative comments we've had about that, but certainly we want to be mindful of that. Point's well taken.
Other comments, questions? Thank you, Jonathan.
Thanks, sir.
Mike Phillips, utility and solid waste fee changes.
Morning.
Morning, Mike.
So I'm going to cover both the solid waste fee changes as well as the utilities. First thing I'm going to do is cover solid waste and break that down into both tipping fees and then our rural household fee before I go into utilities. Taking a look at the FY26 solid waste budget as a whole, our revenues are $3,848,575, and expenditures are $4,530,572, which leaves us a deficit of about $682,000. But this budget does have all of our CIP requests. I think Jonathan mentioned it was $330,000, with the exception of a new convenience center. So looking at the deficit, we knew we were going to need a rate increase. So before trying to calculate that increase, we went through the exercise of separating all costs and revenues which were associated between the landfill and the convenience sites. So basically we split them into two kind of separate budgets to better identify where the rate increases needed to be. So this slide kind of just shows where the revenues and expenditures lie for each, as well as where the deficit shows up for each one. So you can see the landfill has a deficit of $167,131, and our convenience centers are showing $514,867. So what do we do to generate revenue? So with the landfill, it's generally through tipping fees. We collect currently C&D waste is $58 a ton. Yard waste is $53 a ton, and we average about 10,600 tons per year. And at the convenience center, it is through our rural household fee or our solid waste fee. Currently, we are collecting $125 per household, and that is based on 20,238 households in the county. So I mentioned our CIP request being a total of $330,000, and like the other budgets, we kind of tried to split that out to show where the needs were. Most everything is either landfill or convenience centers, but the first one is the 10-year solid waste plan. We have that split. It's a total of $50,000, $25,000 between the two. I think it was last updated in 2012, so we're certainly due for an update on that. We've got some building maintenance items that are predominantly the convenience center. Those are, mainly, we've got some structures out there. We've got, fencing. We've got some thoughts about installing some new signage, around the convenience centers just to, better show people where to go once they get there. Equipment for the convenience centers is basically compactors. We have planned to replace 2 in the current budget that we're in right now. We were hoping for 3, but prices have gone up some, so we are currently asking for enough to do 3 compactors at the convenience center next year. Landfill, sedimentation, and site work. So I think when we started budget, this number was closer to $200,000. But we were able to do some of this work, the more needed work, I'll say, at the landfill. If you remember, I brought a change order to the commissioners a few weeks ago. We had a contractor out working on our expansion site, and they were able to help us with some of this work while they were on site. So that number is down to about $75,000, and it's just more of the same. We've got some erosion issues, some ditches that need regrading, a couple pipe replacements. We've got some sedimentation ponds that need cleaning out. So that's where we come up with that new number. Equipment, mower and box blade, again, this is for maintenance needed at the landfill. We have an existing tractor now, but, this would help us better maintain our roads going around because they're all gravel and dirt roads, as well as be able to do some mowing on some of the banks of the old cells. All right, the next 2 slides, they basically give information, and hopefully they're together on your paper. They're going to be separate up here, but they give information on other counties, their solid waste fee, tipping fee, how they collect their and dispose of their waste, and they're more for kind of informational purposes, to show where everyone else is. Although it's kind of hard to compare apples to apples because it seems like county to county everybody's doing something different, but it does show you kind of where our fees lie. All right, so going back specifically to the landfill budget, based on our current budget, including the CIP, the landfill budget has a deficit of $167,131. Our tipping fee is currently $58 for C&D and $53 per ton for yard waste. And for every dollar we were to increase that, we can collect an additional $10,600. The last 2 years of rate increases that Mr. Hill had brought have been $5 per ton. And if we were to just do $5 per ton in FY26, that would generate about $53,000 in additional revenue. So we looked at 5 options for balancing the budget out to landfill. All will require a rate increase, but the options range from having none of the CIP items that we asked for included to having all options included. So option 1 would be a $5 per ton increase, which I already mentioned is about $53,000, but it removes all CIP items. Option 2, we would keep the 10-year solid waste plan only. Now this is contingent when we get to the piece about convenience site, because we split it 25-25. In order to fund it, we would have to fund it there as well. Option 3 is a $7 per ton increase, and this would allow us to keep the mower and box blade only. Option 4 is an $11 per ton increase, and we would be able to keep that $75,000 in there for the landfill maintenance. And option 5 would be a $14 per ton increase, which would keep all CIP items. And I'm just going to pause right there to see if anybody has any questions about those options.
Questions? Mr. Davis?
Mike, do we not have a required set aside, in the solid waste fund, that we have to set aside each year for ongoing operations of the landfill?
We have, I'm trying to remember, apologize, first year doing the solid waste, budget, but it's called,
It can come later if you like
Okay.
that question to be answered.
there is a balance for, John, can I be here? For the, yeah, the cell closeout that we have to, but it's,
That's what I'm thinking.
yeah, it's restricted for that, yes.
Okay.
And so I can get back with you, but you want to know the amount?
But there's a minimum amount we're required to keep, and we have to report on that every year. So basically, anything above that could be used for other capital. So that's funds we have to set aside, and we do not rely on for any of our capital needs. That's just, if we were to have a breakout in one of the cells, leachate, part of our inspection, we have an issue need to be addressed, that's funds that the state wants us to have available to address those issues as they come up. But we can not rely on that for ongoing operations or maintenance at the landfill.
I don't know where that, fund balance stands now, but in sometime years past, it was considerably more than we had to, but I have no clue where it's at now. I haven't asked the question lately. If we might take a look at that. Just my general comment, I hate to see us do anything near a $14 per ton increase, but, I understand your numbers very well.
Do we have a percentage of fund balance that we require in this area, like we do with our other fund balance?
No, the only required fund balance we had is that required by the state for closeout of the sales at the landfill. We do not have an internal fund balance policy for the solid waste fund. But you will hear Mike talk about a recommendation for the utility fund, and we certainly could also prepare a recommendation for the solid waste fund. And we're starting to have some initial conversation with Davenport around the topic of utilities, and something we could add solid waste to the conversation.
Does the board think we need something like that? Commissioner Davis?
I don't.
Commissioner Howell nodding his head.
I don't think we should start the process of having fund balance in enterprise funds. Just my thought is something I don't generally see, and I'm not sure. I hadn't seen what you're talking about in water and sewer yet.
Well, don't we have a fund balance now?
We do.
Okay. We've already started the
We have
process.
about
then,
1.2
haven't we?
million.
We just hadn't decided what we want it to be.
And 1.2 million in utilities, and I want to say the number in solid waste above and beyond what statute requires is about $1 million. And that's anticipation of, you need to have a fund balance, particularly enterprise fund, because that's self-funding. So if we have a large project that comes up, we hope we don't have unexpected projects, but if we do, something we could draw on to fund those projects, or if we're looking at expansion of the system and we can't identify grants, or maybe we're looking at a short water main extension to accommodate an industrial project or some county-related initiative, fund balance we could draw on to fund that project. So yes, we do currently have fund balance in each of those funds. What we do not have is a defined target above and beyond the state requirement for the solid waste fund.
That was what the comment was based on, Mr. Chairman, to not have a set percentage that we had to do. Certainly, we have fund balance in both of these accounts. And what I would like to know is what we're above the state requirement at the present time in the closure sale fund balance. Because there may be some revenue there we could utilize.
Well, I don't even know what the state requirement is, so maybe that'd be a good idea to educate the board on what the state requirement is and a recommendation from someone telling us if we think that is adequate, do we need to have a higher number? I mean, the state requirement for a regular fund balance is what, 8%?
It's a rule of thumb, it's not a requirement.
8% though is the rule of thumb,
Yes,
and ours is 20%.
yes.
Correct.
Okay. Commissioner Howell?
I just got a question kind of around this tied to the fund balance.
Fund balance.
Since this is a service that we provide and there's a fee charge for it in this account, shouldn't those accounts be self-sufficient? In other words, we shouldn't rely back on our general fund balance to support replacement and maintenance of these items, the fees that we charge the consumers should be able to cover the cost of this and also the upkeep, maintenance, and expansion of the program, right?
That is the intent. There's no proposal here for funds from the general fund to augment operations or capital needs in the solid waste fund. Fund balance I referred to is a fund balance in the solid waste enterprise fund.
But the way it's looking currently with the increase in charges and everything, we're in a deficit for this year, correct?
This is looking at FY '26. In the absence of a rate increase, we would need to draw on that $1 million fund balance to balance our budget.
Right, which would pull away, which takes away from expansion and the other projects you're trying to do.
Anytime we use fund balance, it takes away resources for other projects. Yes, sir.
Other questions? Commissioner Arrington?
So, from my understanding, so if you don't increase, you have to use part of that fund balance.
Or not do some projects.
And I kind of agree, you know, that it should come close, our fees should come close to making it self-sufficient, that it funds itself.
Yeah, that's our, I mean, just like we're talking about with general fund, but ideally, we know there are times, and we're talking about an FY '26 budget cycle, using some fund balance to balance our budget. But just like we're having the conversation in general fund, we don't rely on fund balance in the solid waste enterprise fund to fund ongoing expenses. And primarily, there are some capital obviously included in that deficit that Mike shared, but try to cover our cost with the fees that we're collecting.
Other questions?
Recommend option 2.
Yes, so the recommendation we have is option 2, which is raising the tipping fee by $6, which would put our C&D tipping fee at $64 and $58 for our yard waste. It does remove the landfill deficit, and it would allow the county to update the 10-year solid waste plan. Again, that would be contingent on what we do on the convenience site piece, but it would allow us to do the $25,000 side for the 10-year solid waste plan update.
Everybody good? Good? Go ahead, Mike.
All right, so the next piece is for the convenience center fee increase. So based on the existing budget, including CIP, the convenience center budget has a deficit of $514,867. Our current rural household fee or solid waste fee is $125 per household. And again, that's based on 20,238 households. For every $5 we increase here, we collect an additional $101,190. And I just want to point out that the last increase that we had on the solid waste fee was in 2015, and at that time it was $29. So again, we've come up with 5 options here, based on different fee increases as well as either cutting services. We've got some pros and cons to each one. But the first one is increasing the solid waste fee to $155, which would be a $30 annual increase. We would not change, there'd be no change to the CIP request or services. And so basically the same types of frequency and types of service. The con of this is it is the highest increase, but it would generate about $607,140 worth of revenue. Option 2, we would remove most CIP items, and I say most because this one does include leaving the compactors, because again, we'd like to, rather than run them to failure, complete failure, try to swap some of them out every year. It's usually about 3 or 4 of them for every convenience center. Again, as far as the pros, same frequency and type of service. It removes the CIP items that it does remove is the 10-year solid waste plan, which was, again, $25,000, and needed maintenance, which was the $40,000 that we were going to use around for the convenience sites. Option 3, we would raise the fee to $150, which is a $25 annual increase. And in this option, we would close the convenience centers an additional day, which would lead to about $69,498 worth of savings. Most of that is based on just the part-time salaries for the employees. We assume that if we did close another day, we would still collect the same amount of waste, it's just more people would come on other days. CIP items remain in this option, and the service type remains the same, but the frequency of service is reduced. And again, we didn't select a day, but it would just be one additional day. But it would generate $505,950 in revenue. Option 4 is again $150, which is still a $25 increase. And we would discontinue construction and demolition collection at the convenience centers, and that would be $105,908 in savings. Again, we keep CIP items. We're able to keep the same frequency of service, and this could provide some additional space at the convenience sites if we weren't having bins to collect C&D at these locations. But it would be a service type reduction, and this would also generate $505,950. Next option would include increasing the fee to $142, which is a $17 annual increase. We would discontinue, again, the C&D collection as well as yard waste at the convenience centers for potential savings of $229,180. Again, we keep CIP. We keep the convenience centers open the same amount of days now. And again, this comes down to we could increase some additional space if we were removing the bins for yard waste as well as construction and demolition. So again, service type reduction, and this would get us about $344,046. Final option, which is option 6, we would increase the solid waste fee to $135, which is $10 more than what it is now. Again, we remove most CIP, but that wouldn't include the compactors. We would close the convenience centers an additional day and discontinue C&D and yard waste collection. So in this option, we save about $363,678. And it is the lowest fee increase, but it removes all CIP items, and we reduce the type and frequency of service. And this would generate about $202,380 in revenue. So I'm going to just pause there before I go on to the recommendation to see if anybody has any questions about those options. Go ahead.
Questions? Commissioner Leggett?
Was it considered to reduce the number of sites that C&D was collected at? Maybe have just a selected number of sites around the county instead of all?
It's certainly an option. I didn't run any calculations. I mean, I have to pick however many we were going to reduce it on. I mean, certainly a potential to keep one in the north and, kind of spread them out some.
Well, just, considering the size of our county and the location of our C&D landfill.
Yeah.
And on the C&D, it's not consistent across the county at the convenience sites, is it? Some locations actually have compactors and some locations actually have open tops. So what you're allowed to throw in at each facility, to Sue's point, is different at each of the sites?
Right. The ones with the compactors are typically our what I call household garbage as well as recycling. The open, kind of the open bins at the top is our bulky waste. It is the C&D, yard waste, things like that, things that you just throw in the top. But then those items are hauled from there to the landfill.
I guess clarification, because like I know in the Middlesex area, the C&D is not an open top, it's actually a compactor, and you have to have everything cut to 4-foot lengths or less and put it inside the bin. So it's not real useful in that case, whereas I think in other facilities in the county, they are open top and you can just take it and dump it in.
Right, and the majority of the ones I've been to are the open top. I don't know that I've seen the compactor with the C&D, but it's interesting.
So you're thinking most of them are open tops then?
I feel like it, yes.
Okay.
Other questions?
On the site with,
I hadn't heard of it before we mentioned it.
I hadn't seen one.
And the reason why I asked that is I know there's a lot of complaints from the employees there because it gets jammed up all the time because you got to take 2x4s and put them in there and they're 4 foot in length. So you have to cut all the material down before you bring it. So kind of to Sue's point, if we had a limited location, they were all open top, it would have been much more beneficial at that convenient site not to have one, and have another one that had an open top that you could go to and throw it away versus having to cut everything up. Plus it jams the compactor up a lot with all that wood in there as well.
Other questions?
Maybe we need to remove that one. So
Excuse me, I didn't hear you.
I said maybe we need to, at the one at that site, we need to remove the compactor to an open dumpster.
Well, you can evaluate that, Mike, you and take a look at that.
Which site did you say it was at?
Middlesex, Stony Hill.
Okay, all right.
Commissioner Davis?
Or they put it in the same compactor that the.
It has a separate compactor, it's a door, and you have to open it up, and everything has to be 4 foot or less to fit through that compactor door and get in there, but
But
then.
the garbage is not the same one for the garbage.
No, there's 2 for garbage compactors, and then there's 3 open tops for general things like mattresses and sofas and stuff like that, but your construction debris actually has to go in a compactor, and it has to be 4 foot or less to fit in there.
I didn't know
And-
that, I can see that to be very problematic.
Citizens have complained about it, and so do the employees, just because it jams up bad putting that wood in there and breaking it.
Right.
Mike will take a look at it.
Okay, so our recommendation would be to raise the solid waste fee to $150, which again, $25 increase. And we get that revenue impact of $505,950. But we would discontinue C&D hauling and disposal from convenience centers. Currently now, Edgecombe, Wilson, or Halifax, some of those offer this service from the convenience centers. And again, we'd have $105,908 in hauling and disposal savings.
Commissioner Davis?
I would highly recommend we take option 1, $5. I don't think it's worth what us commissioners are going to hear, as well as the additional issue it's going to put on our employees to not continue to operate like we operate. Just my thought.
Other thoughts on the recommendations? And now's the time to express it.
I'm in support of raising it to $155 to $30 increase,
That's 2 at 155.
because just cost of removal and stuff has gone up, and that's still a very fair rate to our citizens in Nash County, and it provides all the services they're currently getting, especially if we could get an open top in Stony Hill, that would be really nice.
I got some thoughts, but I'll hold them. Other thoughts? Got 2 at 155. Commissioner Wilkins, Commissioner Leggett, Commissioner Arrington. Any thoughts?
Well, I guess their thought is that, that would put us, I call revenue neutral as far as, fees and deficit. And that would keep everything as it is.
Option 1. Yeah, I don't think it'd be a good idea to reduce service, and I don't think it'd be a good idea to move to C&D, because a lot of people do C&D work and just take it out from a bathroom repair or something like that, so. Anybody object to option 1? I mean, that'd be the recommendation of the board, then it sounds like. Excuse me?
So now you can blame it on it.
We will. All right, Mike.
All right, on to public utilities. So our water and sewer systems are split into 2 different funds, Central Nash and Northern Nash. Here our revenues are highlighted in red for each system, followed by both the expenditures, water and sewer expenditures, and then debt for each system. And looking at each fund in a whole, you can see that both show a deficit for FY26, 55,442 in Central Nash and 20,088 in Northern Nash. So where are the deficits more specifically? Majority of the deficit in Central Nash is in sewer, $45,127 of the total $55,542 is in sewer. Northern Nash Water is actually showing a surplus, but the sewer fund is a deficit of $23,458 for a total deficit of $20,088. So part of the deficit is due to a planned rate increase in our wholesale purchase contract with the city of Rocky Mount and the town of Nashville. Rocky Mount's increasing its wholesale purchase rate by 8.5%, and Nashville is passing on that increase to us as well. And you can see in the slide, what that increase costs us based on our annual usage for each system. So, Central Nash, that increase is costing us $72,470, and on down between Central Nash Sewer, Northern Nash Sewer, our industrial rate. That's the actual cost based on the gallons we're using annually. So this slide kind of gives you a look at ways that we can increase our revenue. I won't go over every number, but you can see how raising the base rate and or usage rate affects our revenue. So for example, if you're looking, I should have put this two different colors, but the two top rows are water. So increasing our residential commercial rate by 6% in Central Nash, we can gain $79,042 in revenue and about $21,197 in Northern Nash. And increasing our base rate would give us $74,550, and in Northern Nash, $15,708. And like I said, on down the list, these are just options for increasing the revenue. And I've got three options to present, which kind of uses a variety of these options to help balance the budget. And each option that we're going to take a look at, assumes our customer usage of our average customer usage of about $5,000 a month. All right, so option one, we would increase our water base rate to $32 and increase our water usage rate by 6%. Again, the city of Rocky Mount was going up 8.5%, but we'd only be looking to go up 6%. We'd increase our sewer base rate to $35, increase our sewer usage rate by 8.5%, and our industrial rate by 8.5%. So, if you're looking at our current customer water bill, it's about $68.95 for 5,000 gallons. And this would increase them by about $4.20 to $73.15, so about a 6.9% increase. And sewer, we would go from $90.60 to $100.10, which is about a $9.50 increase, or about 10.5%. So option two, for the water, it's pretty much the same as option one. We're increasing the base rate by $2 to $32, and increasing our usage rate by 6%. And then on this one, we're actually increasing our base rate for sewer to $40, and our sewer usage rate by 8.5%, and our industrial rate by 8.5%. Again, it doesn't really change anything from option one on the water bill, but the sewer bill would go from $90.60 to $105.10, which is about $14.50 additional. All right, option three, this increasing our water base rate to 32 and our water usage rate by the entire 8.5%, which is what our wholesale purchase rate is going up. And again, this option, nothing changes as far as the sewer, so we're still going up to $40 on the base rate, our usage rate by 8.5%, and our industrial rate by 8.5%. So as far as the water bill, customer's water bill would go up $5.05 to $74. And their sewer, again, would go up $14.50 to $105.10. Any questions about those options?
Any questions?
Okay.
Mr. Davis?
Did we look at an option where we kept the base rate the same and balanced the revenue by increasing the rate beyond the base rate?
I did not look at any options where I went above and beyond what the usage rate was on our wholesale purchase contract, not above 8.5%. There's a spreadsheet I have that has those options, but I didn't recommend looking at one of those.
My thought there is, if we're going to have the mindset that we seem to have of letting person that is utilizing the service, pay the bill for the service, would be to hold the base rate the same and collect the additional fees that you need by the increase in water usage. And my other thought there is it would certainly help, most likely or more likely, our senior citizens more, thinking that they wouldn't only have 2 people in a household. And not something I look at much, but I'm a little surprised at what our base rate is already, and would hate to see it go up any more than what it is. And I just think if we could hold that the same, I would at least like to see what the usage, what the additional water rate would have to be.
Okay.
That makes sense to everybody.
It does. You know, our bill is pretty much the way it is now. You know, when we raise the base rate, it has an effect, but I think you can see here that even looking at this one, it's about 50-50. When we increase the base rate and we increase the usage rate, it's about a 50-50 split. I don't think we have increased the base rate since 2018 for our water customers, and I want to say it was 2021 or 2022 for our sewer customers. And at that time, it had gone from 20 to 30. So I guess that's been 7 years on the water.
Other comments? Commissioner Howell?
Just a question for clarification. So the base rate, though, it does include so many gallons, correct?
It does not.
So the base rate includes no gallons. I thought it was like 5,000 gallons. Is that the sewer?
No.
So none of the base rates includes, it's just the basic fee. Then you have to pay
For your
per
usage.
gallon, so there's no gallons included with the base.
No, I think it used to be probably 2013, 2014, somewhere in that time frame. I think that there was 1,000 gallons included on the water. But not since probably about that time has it included any usage. But it used to be the first 1,000 gallons were included in the base rate.
I did not realize that. I thought we had
I thought so. It's kind of like electrical as well. Okay.
well, I'd have to think back through my comment then.
Other comments? Go ahead, Mike.
All right, so our recommendation is option 2, which would increase our average water bill by $4.20, and our average sewer bill by about $14.50. To your point, Mr. Davis, the 248 customers we only have 248 sewer customers, but you know, they're the ones paying for that service. It eliminates the Central Nash sewer budget deficit and closes the gap in the Northern Nash sewer budget by about 37%. And it increases revenue in Central and Northern Nash budgets to help cover City of Rocky Mount rate increase and helps address future capital needs.
Comments? Commissioner Howell?
So it closes the gap on the Northern Nash sewer budget by 37%. What about the remaining?
It will basically be made up, because again, they're broke down into Central Nash and Northern Nash, so the remaining will end up being covered by the water budget to balance the budget.
So you're using the water budget to cover the sewer?
And those two are in the same fund.
And there's still a fund balance left in those accounts as well, correct?
Correct.
Other thoughts or comments on the recommendation? Commissioner Davis?
The real issue there, Freddie, is just so few sewer customers that we have in the county. And so it's just hard to make that, it's almost impossible to have a reasonable rate to make it work. Therefore, Northern Nash subsidizes the sewer cost with the water revenue, which is not uncommon in the utility fund.
Yeah, I think we only have 33 customers in Northern Nash sewer customers.
Right.
And then on the water side, so we're charging, I'm just trying to understand, we're charging the water rate is the same for the county regardless of who we buy it from.
Say that again.
So Nashville or Rocky Mount, water, sewer, any of that, so it's the same rate for the county regardless of what our cost is.
Other thoughts on the recommendation for option 2? For or against?
The only thing I would add about, just to the comment that Commissioner Davis made, if we try to adjust the consumption rates to eliminate the increase in the base rate, what Mike has shown is about a $2 increase in the base rate. If you divide that over 5,000 gallons, that's 40 cents. 40 cents per 5,000 gallons. That's what it would add. So you actually have you didn't actually have your rates, but I mean, you're just shifting the cost from the base rate to the consumption. So it would help a customer that's using less than 5,000 gallons. Say if they're only using 2, they'd pay an additional 80 cents. But if you use 5,000, you would pay the additional $2.
Well, honestly, my thought, the way I had it originally, it doesn't work anymore, knowing they don't get any water in the base rate. So I'm fine like it is. I'm trying to help the seniors out if I can. Then,
Other comments? Okay, Mike.
All right, so we've kind of discussed, the fund balance policy a little earlier, but staff is recommending creation of an internal policy for fund balance in unrestricted cash. Obviously, a well-defined fund balance policy helps ensure financial stability, supports capital planning, and prepares for unforeseen expenditures. We've looked at similar size utilities, and they identified fund balance policies based on a percentage of their annual operating expenses and debt payments. And several jurisdictions have identified utilizing the target of 6 months of operational expenses and 1 year of debt service. So using that model, obviously you see our operational budgets for both Northern Nash and Central Nash, as well as our debt. So we would propose to target a fund balance of $1.92 million for Central Nash and $635,000 for Northern Nash. Our current fund balance for both funds is about $1.28 million per the FY24 audit. About $240,000 of that is in Northern Nash, and the rest is in Central Nash. So again, we'd be looking to establish this over the next, say, 3 to 5 years, this fund balance. Any questions on?
Any questions, comments?
I would need him to go back through it again. I haven't comprehended it yet, Mr. Chairman.
Go back through it again, Mike.
All right. So we had mentioned, because I think you brought up solid waste, but we're recommending the creation of an internal policy for fund balance and unrestricted cash. Some other places that we've looked at, similar size utilities, we identified policies based on a percentage of their annual operating expenses and debt payments. Several jurisdictions that we identified utilize a target of 6 months of operational expenses and 1 year of debt service. So based on that model, and if you're looking at our operational budgets for both Central Nash and Northern Nash, as well as our debt, our proposed fund balance target would be $1.92 million for Central Nash and $635,000 for Northern Nash. And again, we have a current fund balance of $1.28 million, and about $240,000 of that is in the Northern Nash, and the other roughly a little over $1 million is in Central Nash. So we'd be trying to target this in the next 3 to 5 years.
So the policy you want to establish, we're going into with half of the funds we need to meet your target. Is that what I'm seeing?
Well, maybe half in Central Nash.
I'm looking at total.
Yeah, if we're splitting it, currently Northern Nash's is about $240,000, so we'd be about maybe a little better than a third of the way there.
And what do you do when you start like the new district, the new lines we're putting in now? We know we have a ramp-up period to gain customers, but the cost starts in the front end.
Right.
So aren't you gonna have a period of time where you gonna automatically fail to meet this requirement because of ramp-up time needed after a new district is opened up, or in addition to it, a district is opened up? Have we thought about that?
Yeah, I'm thinking the thought process is that, you know, this is a target as of today. And this is probably something we'll have to revisit. I don't want to necessarily say yearly, but, something we'll have to look at again as year by year goes by.
So we're presenting this as a target, not as a policy.
That's correct.
Okay.
The target, not the policy.
Okay.
And then the other thing I would say to your comment about the project we'll get ready to take, we are very fortunate that project will be
You're right.
funded with ARPA dollars.
Yeah, in that case, it is.
Yeah, in an environment where we did not have grant funds available to fund the project, then yeah, we'd have a lot of debt on the front end, and we'd have to ramp up over time to cover that debt. So we are in an enviable position with the project. We're getting ready to start next month, and hopefully the project will be bidding in May or June that has a state ARPA dollars attached to it that will bring additional revenues that will hopefully accelerate our efforts to meet this internal target that we've set. It's really just taking the mindset, starting the conversation about setting an internal target for fund balance in our utility fund, and we've already had a conversation today about maybe having a similar conversation in solid waste, but just to get some buy-in from the board, because we want to be in a position where we've got some reserves to draw on for future expansions, capital needs as they come up, and not have to come to the board and ask for a loan from the general fund to make it happen.
I'm fine. I want to understand it's a target and not a policy, because I think we're going to have problems at all times meeting a policy.
Right.
Other questions, Mike? Any other questions? Commissioner Arrington?
I guess it's kind of a general understanding that the northern water system not subsidizing the central. I said, right, I say it's kind of making it clear that it's not, you know, when you talk about it, it makes it sound like it is.
Well, I would say the only distinction is we have one utility system. We operate it in two districts. And Mike mentioned, you know, we have a fund balance in the utility fund of $1.28 million in cash. That actually is not, you know, if you go to the audit report, you won't necessarily see what the number is for the Northern Nash District versus the Central Nash District. So I can't say historically that one district has not supplemented the other, but it's one utility operated by the county. And kind of to the question that Commissioner Howell asked earlier, you know, we have one fee schedule for the county, and they apply to both districts the same. You know, there's not been an attempt to try to alter the fee schedule based on the operational costs of one district versus the other. We treat them both the same. But as the proposal Mike has presented, you know, certainly our proposal is to have each district support itself. And in this case, the fee schedule, the Central Nash District would actually raise a little bit more money than we need. And the recommendation is really kind of driven more about what we need to make Northern Nash whole in FY26 as opposed to Central Nash. But no, the intent is not to have one supplement the other, but again, I want to just emphasize, we only have one utility.
Other questions for Mike? Commissioner Davis?
Just in general for the water and the sewer, just to kind of piggyback off what's been said. We've been very fortunate and blessed that we've had a lot of grants come through to do a lot of this infrastructure repair and placement. And I think as the country's heading forward and the cuts are coming with everything, I think it's very important that we plan ahead and do have the funding here to be able to make necessary repairs and or replacement of dilapidated infrastructure without having to pull additional funds in, especially when we're looking at our credit rating earlier this morning. So whatever we can do to get this self-sufficient to where it is sustainable, and when I mean sustainable, I mean that it can take care of the rates on its own without having a deficit, and also accumulate some wealth in the system to where it can make replacements and or end-of-life use of equipment needs to be included in there as well. So whatever that needs to target balance needs to be at, I think we need to make sure we include that. So we don't come up with surprises and end up in the same situation we're in now with some of our aging water systems that we've got and having to make all that investment in there, because I don't think the grants are gonna be there for it.
Did you have other comments, Commissioner Davis?
One more thought, and I certainly agree with what Ms. Tile said 100%, but Jonathan, the districts, if I'm not mistaken, are separate districts because only the citizens in that district are responsible for the debt on each district. It's the way we started out. Are we still in that same mindset?
Yes and no. When the Central Nash District was created, it was basically created because of the funding mechanism that the county used at the time, the
That's
USDA.
Correct.
So we had to physically create a district, and yes, that district would be responsible for the debt
That's right.
repayment on those grants. We have since refinanced those
You got rid of
loans, so now we're no longer under that requirement with USDA. But we still have the district in place. Northern Ash, we have a district, we have a boundary, but there's actually not, to my knowledge, a legal entity created like there was when Central Nash was created. So we have both.
You're correct. And you, I keep forgetting the fact that that debt's been refinanced, so the way you're doing it works. With it all being together, at one time it would not have worked.
Other comments? Okay, Mike, you have anything else?
Yes, sir.
Thank you. It's a good presentation. We're going to ask Jonathan if he would to give us a tour of the building, and they're going to set up for lunch, and when we complete the tour, we'll come back and have lunch, and then we'll get started again, okay? Call on Emily Moore. She's going to go over outside agency funding recommendations. Emily? And while we wait for her to get up there, I guess, Gwen, you picked the menu for today's lunch. It was a very good lunch. Hope everybody enjoyed the lunch.
Thank you. And I thank Stacy for recommending that restaurant. So it was good.
Thank you.
Okay, Emily.
All right, well, let's see. I am here to present the Outside Agency Funding Committee recommendation. So an overview. Nash County has an appointed internal outside agency funding committee. For fiscal year 2026, completed applications were due February 14th, 2025. Focus areas for funding are education, workforce, housing, and health and safety. The minimum request allowable was $3,000, and the maximum request are $35,000. This year, the county received 15 applications that totaled nearly $400,000 in funding requests. So that amount is more than double the amount of funding that we had available. This chart shows the history of agencies that were funded by Nash County. This chart goes back to 2018-2019, and the chart only includes the approved funding, not the requested or the recommended. For this year, we looked at our scoring rubric that had each application evaluated in 6 categories. Each category scored between 1 and 4 points. Those categories were funding requests, not more than 50% of budget. So what we looked at was if programs were solely reliant on the outside agency funding. We looked at revenue versus expenses and the funding impact of the outside agency funding. The next category was if the request aligned with the agency mission, if the request aligns with the agency capability, so we had looked at agency experience. We looked at collaborative efforts associated with the program or service, the demonstrated impact of program outcome, which once again we looked at previous experience, but also their proposed outcomes, and then the degree that the program augments or fills a Nash County gap in service. So for our recommendation, for each of these agencies, I do have a short summary of the program as well as an explanation for our recommendation. Downey's Partnership for Children. The Family Resource Center will serve as a hub for family, child care, community supports with indoor and outdoor play space, provide support and referrals to programs, and a play and learn group for children who are not in formal care. The target audience for this program is children in poverty, single-parent children, or children who are under the age of 5 and in family, friend, or neighbor care while their parents work. For the Downey's Partnership for Children, we are recommending $18,930. And this is based on the program. It supports and enhances early education and is not duplicative. The program is sustainable and well-established, and it has very strong partnerships. The next one we looked at is Peacemakers. The Freedom School, which is the Peacemakers program, provides 6-week intensive academic enrichment program that focuses on reading, children with social and emotional learning experiences, parents with tools to support children academically, and provides participant meals. The target for this program is low-income elementary and middle school students, priority placement for referrals from juvenile court counselors, school social worker referrals, DSS, homeless children, and children with an incarcerated parent. For Peacemakers, our recommendation is $18,930. And just like with Downey's Partnership for Children, this was based on a program that supports and enhances education and is not duplicative. The program is sustainable and well-established, and the program also has very strong partnerships. The Boys and Girls Club. Their program is a Formula for Impact, which provides club members with annual educational enrichment opportunities, including 1 hour of homework assistance each day during school weeks and year-round tutoring, mentoring, and access to educational resources. Club members also receive annual healthy lifestyle enrichment opportunities. The target population is children who are ages 5 through 18, especially if they struggle academically or if they're in areas of high unemployment, dropout rates, juvenile crime, or teenage pregnancy. For the Boys and Girls Club, we are recommending $18,930. This program supports and enhances education and is not duplicative. The program is sustainable and well-established, and it has strong partnerships. Spalding. Spalding services include hosting the Spring Hope Library, the Downey's Partnership Play and Learn program, Nash Community College High School Equivalency program, Nash Community College's Digital Learning and Basic Computer program, and providing physical fitness classes, senior activities, and a proposed tutoring program. The target population at Spalding is those of diverse income, ages, ethnicities, and abilities. With this program, Spalding was primarily asking for operational funds, not funding for a specific program. In our policy, operational expenses are not eligible. Many of the services involve hosting the programs of other nonprofits. So the program that we are recommending funding is their new tutoring program. So for the tutoring program, we are recommending $3,000. Communities and schools. Communities and schools, the CIS model, integrates student support into 3 Nash County public schools. Community and Schools Support Specialist works with teachers, counselors, social workers, and school leadership to identify school-wide needs, accept referrals for students, and coordinate tailored, evidence-based support programs, and interventions. The target audience for communities and schools are students who are struggling with attendance, behavior, and academics. This program supports and enhances education. The program is sustainable and well-established, and it does have strong partnerships. In line with our previous year recommendations, the committee recommends $7,500 for education applicants who were not funded in the previous year. Casa Azul de Wilson. This is a mentorship program for high school students to mentor middle school students. The mentorship program is to ensure that Latino students do not fall behind in reading comprehension and writing skills. Latino families often face challenges supporting children with homework and literacy due to language barriers. The target population is bilingual students, middle and high school Latino students, low-income families that cannot afford tutoring. 25% of the students assisted with Casa Azul de Wilson are in Nash County, 50% are in Wilson, and 25% are in surrounding counties. So our explanation for the recommendation, the recommendation for Casa Azul de Wilson is $10,000. And our recommendation explanation is that the program supports and enhances education and is not duplicative. The program targets a unique population from other education programs. The program has strong partnerships within Nash County. And last year, we recommended $7,500 as an education applicant who had not received funding in the prior year. Based on program reporting and implementation, our recommendation was to increase that amount to $10,000. That was our final education category. So now on to, we have 3 that submitted as other. The first one is the Nash County Arts Council. The Nash County Arts Council's mission is to promote the cultural, visual, and performing arts and to encourage arts education and activities. The organization strives to have diverse and inclusive arts programming and experiences. The outside agency funding is specifically requested to support the arts education program. The target population is youth, especially those with no or limited access to arts programming. For the Nash County Arts Council, we recommend $5,000. Our explanation is that this program supports and enhances education in a population that may otherwise lack arts programming. It has strong partnerships. However, as with our previous year recommendation, requests from agencies who did not receive prior year funding were recommended at $5,000. A Touch of the Father's Love. A Touch of the Father's Love food pantry aims to alleviate food insecurity in Nash County and is one of the largest food banks in Nash County. This program specifically is to provide mobile deliveries to those unable to come to the facility, including delivery to schools, senior living centers, and low-income neighborhoods. The target population is low-income individuals, rural individuals struggling with food insecurity, and at-risk children. For this program, we are recommending $5,000. The explanation for this is that the program provides a service not otherwise offered, it is well established, it has strong partnerships, and as with our previous year recommendation, requests from agencies who did not receive prior year funding were recommended at $5,000. United Way. The United Way program, the 211 Information and Referral Program, is a free phone line online referral program that helps connect citizens with services. The target population is all citizens in Nash County, particularly those that are low to moderate income or elderly. For United Way, we recommend $5,000. The explanation for this is that the agency receives funding from Nash County's United Way campaign. However, United Way does have very strong partnerships, and as with previous year recommendations, requests from agencies who did not receive prior year funding were recommended at $5,000. The Wright Center. The Wright Center offers supportive care, health monitoring, and rehabilitative services to target populations in Nash, Edgecombe, and Wilson counties, and provides caregiving respite. The target population is frail elders and disabled adults who are physically or mentally challenged, suffer from Alzheimer's disease or other dementia-related illnesses, and are facing other health disparities because of their economic or health inequities. For the Wright Center, we are recommending $5,000. Nash County provides program funding to the Wright Center through the Department of Social Services and Senior Services Home and Community Care Block Grant. However, the program does target a unique population and has notable partnerships. As with previous year recommendations, requests from agencies who did not receive prior year funding were recommended at $5,000. United Community Ministries. This is our first one that falls into the housing category. The House the Children program provides transitional housing to homeless families, services to eliminate barriers which cause homeless situations, and on-site educational opportunities. The target population is homeless families with children, homeless families in Nash and Edgecombe County, and very low-income homeless families. For the United Community Ministries, we are recommending $18,500. The explanation for this is that this program provides services otherwise unmet in the county, it is well established, it targets a unique population, and it has strong partnerships. Christian Fellowship Home of Nash and Edgecombe County. The Christian Fellowship Home provides safe, sober, transitional living for members who are either recovering from substance abuse and/or are honorably discharged homeless veterans. It provides recovery programs and transportation assistance. The Home for Individuals Recovering from Substance Abuse opened in 1975, and the Home for Homeless Veterans opened in 2016. The target population is local men recovering from substance abuse and homeless veterans who were honorably discharged. For the Christian Fellowship Home, we are recommending $18,500. This program provides services otherwise unmet in the county, it is well established, it targets a unique population, and it has strong partnerships. The Mercer Foundation. The Mercer Foundation equips disabled veterans with necessary tools, education, and vocational training. The goal is to move homeless veterans towards self-sufficiency. The program provides safe, stable housing, comprehensive support services, and facilities to transition from homelessness to permanent housing. The target population is Nash and Edgecombe County veterans facing homelessness or in need of addressing mental health, substance abuse disorders, or lack of employment. For the Mercer Foundation, we are recommending $5,000. This program provides services otherwise unmet in the county, targets a unique population, and has strong partnerships, including a notable amount of support through fundraising. Tri-County Industries. This one falls underneath the workforce category. TCI Works Day program is a long-term program for individuals with significant intellectual disabilities, including autism. The program provides transportation and engages clients in meaningful activities and work. The target population is Nash, Edgecombe, and Halifax County individuals with significant intellectual disabilities. For Tri-County Industries, we are recommending $25,000. This program provides services otherwise unmet in the county. It is well established. It targets a unique population, and it has strong partnerships. Finally, is Strategic Twin Counties Education Partnership, or STEP. Students at Work is designed to bridge gaps between the classroom and workplace skills. The program will provide work-based learning and support non-college-bound high school graduates to ensure that they are prepared to join the workforce. The target population is underrepresented students who most likely live in poverty and with few resources, and also opportunity youth. Opportunity youth are those who are 16 to 24 years old and who are disconnected from school or are unemployed. For STEP, we are recommending $10,000. This is because the program targets a unique population and has strong community partnerships. Last year, the recommendation was $7,500 as an education applicant who did not receive funding previously or in the prior year. The program reporting and implementation went well, so our recommendation was to increase their amount to $10,000 this year. Are there any questions?
Any questions or discussion? Commissioner Wilkins?
First of all, I would say I don't know where to begin, but my concern is Casa Azul de Wilson, and I've had conversations with many of you on the board and staff. Yes, we approved them last year, and I will have to say, with the exception of Commissioner Howell, who was not here, I feel we did not do our due diligence. Casa Azul de Wilson is in Wilson County, and I don't believe should receive Nash taxpayer money. They may serve Wilson County, but we set a precedent. If we do this again, are we going to start taking applications from Native Opportunity Way, an American Indian organization in Halifax County? Are we going to take applications from the NAACP? Their website specifically targets and says they help Hispanic and Latinx families. We cannot, as a government agency, contribute to an organization that may exclude or is blatantly says that is the ethnicity they support. It says nothing about anything else. And to say that, Downey's Partnership for Children, they're in the city limits of Rocky Mount, as is Nash County is. Again, Wilson is not to give taxpayer money to Casa Azul de Wilson and to give them $10,000 when you have other Nash County entities that are getting less. And not only that, on March the 8th, I received an email from Ms. Tia Fula. After our one-on-one meetings, not one-on-one, but after our individual commissioner meetings about the budget, I expressed concern there about Casa Azul being in Wilson County and not serving all the population. In a nutshell, she responded that in response to my concerns that were raised in the small budget meeting, the funding recommendation for CIS has been increased from $7,500 to $10,000. Yet, I see here, it's still $7,500. So here we have a staff member that has told a commissioner that the funding had been increased, and now it's back to $7,500. And then when I look at the Mercer Foundation, Touch of the Father's Love, the Nash Arts Council, These are all entities right here in Nash County. Casa Azul does not have a brick and mortar place here in Nash County. And so again, are we gonna open it up to other neighboring county organizations and give them Nash County taxpayer money to fund their organizations because they serve individuals in Nash County? Again, we're setting a precedent here. If we're gonna say give the American Indian Organization in Halifax funding if they apply, if we're gonna give the NAACP funding if they apply, have at it. But we're setting a precedent. I am not in favor of giving Casa Azul, Day Wilson, Nash County taxpayer money.
Chairman Outlaw, may I address?
You may.
I just want to address the information that was provided to you by Ms. Tia Fula. I take responsibility for that. It was the board's decision to put the committee in place and make the recommendation. And when we decided to make that change off of your comments, I shouldn't have done that. So I did reverse that and made sure that what was presented to the board today was the recommendation of the committee, and that if there is a change that is made, that is a board decision. That's why that information changed. I take responsibility for that.
And if that information changed, I should have been notified.
I apologize.
And I was not. And so, you know, here again, and as far as the committee is concerned, I just don't feel that this committee for outside agency funding is doing their due diligence. I mean, I cannot believe we would sit here and consider giving taxpayer money to an outside agency. And Communities in School, it said approved the actual budget, actual funding. It looks like they've never applied. They applied in 23 and 24, and they were turned down. The director even came to us and presented. But you want to give someone in Wilson $2,500 more than you're giving Communities in School, who deals with children. They deal with all children. And Ms. Fula had mentioned, well, we have handicap agencies that only deal with handicap. Yes, we do, but they deal with blacks, they deal with whites, they deal with American Indians, Hispanics, they deal with all of them. Casa Azul, on their website, on their information with the Secretary of State, says Latinx and Hispanic families. We cannot favor one ethnicity over another.
Thank you, Commissioner Wilkins. Commissioner Davis?
The Mercer Foundation, I'd like to have you to read that one again. I think you possibly might have been on the wrong line when you read that one, but I want to hear it again so I'll know for sure.
Okay, let's see, the Mercer Foundation.
Yes.
The Mercer Foundation equips disabled veterans with necessary tools, education, and vocational training. The goal is to move homeless veterans towards self-sufficiency. The program provides safe, stable housing, comprehensive support services, and facilities to transition from homelessness to permanent housing. The target is Nash and Edgecombe County veterans who face homelessness or are in need of addressing mental health, substance abuse disorders, or lack of employment. Now, I will say the Mercer Foundation, they do have multi-parts. Last year when they applied to us, it was for a Feeding the Children program.
That's what stuck me, because that's what you have on
Okay,
here.
well, I apologize. That was a carryover from last year, so they
That's
do
no
have
problem.
two different branches.
Okay.
The Feed the Children branch, which we felt like was more duplicative, and then the veterans, the homeless veterans, was much less duplicative and a need that we felt was unmet in the county.
Okay, I'm straight now, that's what stuck me.
And I will say with last year, we asked them to revise their scope and to use the funding for the veterans portion and not the children's feeding program.
Okay.
So that's what they applied with this year.
Mr. Chairman, the other thing, if the matter is able today, I'd like for you to review with us the decision the board made last year about outside funding. I think I recall it verbatim what we did, but I'd rather hear it from you, and the board probably.
You're talking about the establishment of the committee?
Yes.
Right, so the board did establish a committee and put some criteria in place as far as identifying the focus areas. that Ms. Moore went over with the board, and established a funding amount, and also established that that funding amount would grow by the index each year. And so that's what this budget has done this year. It grew by
3.2.
3.2%. And so that's what the committee has to work with to evaluate the applications that are received, and provide the board with a recommendation.
I may have gotten too much into that, but what I read into that was the board felt uncomfortable making these decisions each year about this, and it would lead to a lot more discussion than maybe what the board wanted to buy into. So my recollection is we did this, and then we were going to take the recommendation of the committee that you put together to approve our budget with each year, knowing that if something was there that maybe not suited board members, and I've got one myself, but I'm going to buy into what I thought we did, that we would address it during the year and maybe adjust it moving forward, I thought, but to accept the recommendation as it was put forward to us as is.
That's correct, and it also does help the board with any conflict of interest situation when you've got an independent committee that is making these evaluations and recommendations to the board.
Okay, that's what I thought we had done, but I just want to make sure
Yes,
that I
sir.
didn't read it wrong.
Any other comments or questions? Commissioner Arrington?
Just a couple. Let's see. Well, you use a certain kind of criteria. The Down East Partnership for Children and the Peacemaker, they were recommended funded at the same level that you did last year. The Boys and Girls Club were reduced, and United Communities and Schools was reduced, and Tri-County Industries were reduced. Those are three organizations that we have funded consistently. I guess I want to know is what part of the criteria that they failed at that caused them to be reduced, and what criteria that the Down East Partnership and the Peacemakers did to keep theirs the same.
So none of the ones that participated last year, based on the reporting, none of them failed. The biggest problem was that we had over nearly $400,000 in requests and less than half that to work with. So if we funded them all at the amounts they asked for, there just wouldn't be enough funding. That, or we could accept no new applications ever. So mainly, there just was not enough funding to go around. The reason that the Down East Partnership for Children, Peacemakers, and Boys and Girls Club, we looked at all of them. All three of those were very well established, very strong partnerships. All three were education-based. So we looked at the amount we had and split it equally for them, because looking at their programs, we didn't weigh one of the three as being more important than the other ones, when they all had similar characteristics that we were looking at for their grading criteria. And like I said, they all three fell into education.
So anyway, you just grouped them all in the same, yeah.
Yes, they were all three education-based. Like I said, all three were very well established, had successful programs, experience, capabilities. So they each serve slightly different populations or have slightly different programs, but we did not think one was more important than the others.
Well, I don't know whether that's a good criteria or not, but you explained what y'all do.
Anything else, Commissioner Arrington? Any other comments or discussion? Let me get the board first. Anybody else on the board wish to speak that hadn't spoken? Hold on a minute.
Somebody else.
Commissioner Howell?
I'll look at Robbie, being the new guy. So help me understand the kind of the comments that's been made. So I understand prior to me coming on, there was something we passed or voted on or decided on as a board that we were going to do a committee and the committee's making decisions, and then we're just basically accepting this recommendation? Is that how we're doing this going forward, or are we actually sitting here today going to debate the amount of money that's there? Because I'm kind of confused.
I think we're sitting here today looking at a recommendation from this committee, and this board has the authority, if they so desire, to change those recommendations.
Okay. And I disagree. I'm coming on as being new. I'm fine with
Would that be a
having
fair statement, Ms. Manager?
Sure.
having a committee do that. Maybe if we just get more visibility into it prior to this stage, I guess. I mean, we got a glimpse of this in the small budget meetings, but really there was no discussion. It's kind of, this is what's there. And I'm looking at this kind of as our, getting to our final proposal, what we're going to accept as a budget for this year. Maybe if we get more involvement in it, or just visibility, I guess, to
We can
the
back,
criteria and the information and the things and what's being done before, then it will make it easier today.
we can back things up, if you so desire, and look at anything at any time we want. I think we started looking at this early March. I know I've seen it twice, and I believe everyone in here has seen it twice. And there has been some discussion on it prior to today. Mr. Davis?
Chairman, I think I see it a little bit different than you do. I felt like that well, first of all, for your comment as the new man, Freddie, we did establish a procedure by which the amount would be moving forward by taking what we had last year, tying it to a cost of living index that would increase each year, so we weren't in here every year trying to determine an amount that would be put in this category of outside agencies. That's one thing we did. I felt like, and I'm probably 100% wrong, that we had kind of a ladies and gentlemen agreement that we would put a lot of faith in the committee and take what they brought forward, so we wouldn't be dealing with it every year. But if there's something that we didn't like here, that we would continue to talk with staff during the whole year moving forward to change the criteria, or let them know what we thought wasn't right, who got too much, who got too little, so we wouldn't be dealing with it budget time every year, is what I got out of it. But I can certainly work under whatever guidelines the board wants to work under.
I'm not going to debate how you see it versus how I see it. I think the board has the authority to make decisions. That's why we're meeting and looking at the budget. So we have the authority to make these decisions. I support the recommendations as they're on the board, but I'm one of 7. There are 6 others that have a voice, and if 4 of them wish to change that, then they certainly have the right and the authority to do it.
Mr. Chairman,
Mr. Wilkins.
I just want clarification from each one of the board members. If they are all right with giving Casa Azul de Wilson $10,000, if they are all right with staff telling a sitting commissioner that communities in school would be increased to $10,000.
Mr. Wilkins, let me just interject. She explained that.
I understand she explained it, Mr. Chairman.
That point is not on the table.
I would like to know from the county commissioners here if they are in agreement with giving Nash County tax dollars to Wilson County organizations just because they serve individuals here in Nash County. That's what I want to know. And again, there should be some repercussions why I was not notified that that amount changed after a staff member. And if some of you have colluded behind my back, I resent it, Mr. Chairman. I feel you knew that that amount had changed. Ms. Thula knew, and the county manager said she knew. And you all neglected to notify me.
I did neglect to notify you. I apologize.
Hold on a minute. Let me just make one statement. I don't collude or hide or keep anything from any member of this board. And I resent that accusation.
Well, Mr.
Let me
Chairman,
finish, Commissioner Wilkins.
go ahead.
I resent that accusation. I'm as transparent as I can be on everything that I know. I think I've made that very clear. And I have expressed my support for the recommendation. If the other commissioners wish to make a statement on that, they can. They don't have to, but if they wish to, they can.
And that's fine, but you can sit there and say you don't collude, but I feel that you knew that they had changed that amount. I feel you knew that Ms. Fuller sent me that email.
I did not know.
and That's fine.
And that's the end of it.
Well, I would like to know
I don't
from the
lie
other
and I don't
commissioners.
cheat.
I would like to know from the other
that's
commissioners
the
if
end
they
of my
plan
discussion on
on,
that.
if they plan on giving Casa de Azul, a Wilson organization that does not have a brick and mortar place here in Nash County, $10,000.
Thank you for your comments. Mr. Boone.
Commissioner Davis hit on one of the points I wanted to make, and there was reference to the work of the committee. On behalf of the committee, and I'm not on that committee, but as far as the committee doing their due diligence, I would say the committee followed the criteria and the guidelines that they were provided. And if we want to change the criteria and guidelines, that is clearly within the purview of the board.
Which this
Tell them what the
board,
rules are, what we want them to do, and I have full confidence that that committee will execute that mission. But it's difficult for them to anticipate what concerns may be that have not heretofore been expressed. So I have confidence in the work the committee has done. But again, if we want to, if the board, not we, if the board wants to change that, I'm not part of we, it's the board. If the board wants to change that, that's fine.
and I totally agree with that. This board set that committee in place and approved that committee. They've done their work according to their criteria, and this Casa de Azul was funded last year, so it's not a precedent. It would have been a precedent last year, but it's not this year. But again, if the board wishes to change anything, I agree with your approach, change the rules. Emily?
I'll say it was a precedent to award a Wilson County one, but we do have two other agencies whose brick and mortar location is in Edgecombe County. So we have previously and historically for many years awarded foundations or nonprofits whose locations were outside of Nash
Down East
County
Partnership would be one of those.
and then Tri-County Industries, but they
Exactly.
serve Nash County residents.
And we have long funded those two institutions. Other comments or questions, discussion? Commissioner Arrington?
Well, I would just say that it'd probably be a good idea if we want to revisit the criteria of the committee each year and see if there's anything that we want to update, change. So just as a comment to possibly revisit, so that the committee will all understand the criteria.
I'll make a note of that, and I assume everyone else will. Other comments? Commissioner Legg?
I'd just like to comment that I appreciate the work of the committee. It's not easy work, and I think you have to have some kind of standard and rubric by which to operate, because there are a lot of needs, and I think having some kind of standards, we just have to do it that way, unfortunately, because we don't have a great budget to work with. So I support the recommendation. I appreciate the work they've done.
Mr. Chair.
Ms. Wilkins?
Just to clear up what Ms. Morse said, as I said earlier, the city of Rocky Mount is one city. We share it, Nash County and Edgecombe County, and those two agencies she mentioned are in Edgecombe County, but in the city. If those two agencies were in the county of Edgecombe, I would be saying the same thing I'm saying for Casa Azul. I just want to make that clarification,
I'm supportive of both of those institutions.
as am I.
Other
The two
comments
she
or
named.
discussion? Mr. Boone?
One other comment. I think we kind of hit on it, and certainly Commissioner Harrington hit on it. The work of this committee is likely only to get more difficult every year when we get more applications, more folks doing good work, which is a great thing for Nash County. But when we're growing the amount of funds we allocate by, let's just say 3 to 3.5% each year, their work's only going to become more difficult. So I just want to acknowledge that.
Other comments or discussion?
I did not
Mr.
see it,
Davis?
but I certainly, would like to thank the committee for the work they did. And, I think you did a great job with the criteria you were given. And thank you all for performing the task that you performed.
Any other comments? Thank you, Ms. Boyle.
Thank you.
All right, we're going to move now to employee compensation. Ask Tim Kerrigan, Human Resources Director, to come up, make a presentation. We'll talk about COLA and the merit pay recommendation, talk about the salary study, annual contract. We'll talk about electronic timesheets, close it out with new pay schedule.
Okay. So as mentioned, several things on employee compensation, and this will be a review of some of the things that we have, majority of what we've discussed in our smaller meetings. But the first one is the COLA and merit. So what is being proposed this year is to have a two-tiered system for employee compensation. And originally in the meetings, we had prepared a 5% total allocation. And of course, this year, being no different than every other year, it is going to be based upon budget allowance. So we have updated those numbers, and what we are proposing now is a 4.5%. So take total salaries, 4.5% of that, and that is the amount of money to work with. So one of the things that we would like to see is to have an established COLA. Many times we're no different than many other counties or municipalities where it might be called a COLA, but it might in fact be, or it might be called merit, but it might be one or the other. But to truly have a COLA, I would like to affix it to a number that we don't produce, but is one that we can look at, we can Google it, we can find it, and that would be the Social Security Administration is the one that I propose. This year, their cost of living adjustment is 2.5%. So of that 5%, 2.5% would be awarded to all of the employees in July. So from the 4.5 original to the 2.5, we would then have 2% remaining, which would be utilized in a what I call blended merit. So the 2% is the total calculation that we had, but not every single employee would get 2%. And of course, it would not be awarded in July, it would be awarded in January, which if it were awarded in January, that money would shrink a little bit. It grows because we're not using it until January. But so the law enforcement, the sworn law enforcement as proposed, they would get 4%. And then the rest of the full-time staff, they would get it based on their merit. So if the employee was meeting standards, they would receive the 2.5%, which would get them back to what we originally proposed of a total 5%. They just wouldn't get all of it at the beginning of the time. They would get some of it in January. Those exceeding expectations would get up to 4%. And those that do not meet expectations, they would be on a performance improvement plan for 3 months, which means they would not receive the increase. But after 3 months, if they successfully complete their performance improvement plan, then they would then get the 2.5% for that the other meeting standards would get, but only at that time. A couple things of note. There has been concern, it was raised by some of the commissioners, of when you raise the hourly rate for the employee, not once but twice, that might overinflate the net for the coming year, because you would have one increase and then another, and that we might fall out of favor in budget, or we might increase salaries too quickly. And I have prepared spreadsheets. I've been working on that, and I've also asked the deputy manager to work with me on that so that we have a little bit more clarity. But nonetheless, it would not exceed the fiscal year 26 amount, and we would also take into account on future year impacts. And that would mean on a 3-year rotation, so that what we would establish this year would not put us in a less favorable situation next year. One of the reasons I mention on a 3-year, just like with capital improvement projects or anything else, as we had discussions earlier, you can't just look at this year. We have to look at things ongoing. If we're asking for some consistency or some direction, I would like that our messaging be that we're looking at it this year, next year, so we have some clarity for all of us as we go through budget planning, but also some clarity for the employees as to what to expect. Another part of this that is up for consideration is having a planned salary study. So many times, or sometimes, we do studies out of need to catch up, and when you do that, the sticker shock can be sometimes overwhelming, and you can either have a freeze on positions to make the budget meet, or some other drastic measures that you have to catch up. So some of the benefits of having it divided over 3 years, that means you take 1/3 of the employees and study them in year 1, 1/3 in year 2, the other 1/3 in year 3. Year 4, it comes back to the first group. So of course, you have some stability, you have planning, you don't have drastic changes. But one of the things is that nonstop, every year, because we're studying just the market data for one of those sectors, we're still looking at law changes and regulation changes that affect especially HR and the finance department. So you're studying all of that annually. So there's that added benefit so that we don't get behind. And I'm sure that Nikki would echo that statement. So really just having a plan. Another benefit here is that one of the things I've noticed in just under a year of being here is we have a lot of in-year requests of salary changes, position changes, different requests like that. In a perfect world, you're putting all of this work in annually, and the department heads are bringing up their needs. What would be nice is that we have a lot fewer of those throughout the year. And if those departments know that they were just evaluated and their pay was increased, perhaps, not always. A lot of times when you do a system like this, along with the next step that we'll discuss, or with the COLA and merit, you don't have drastic changes, but certainly not in each of the individual positions. So the idea would to not have all of those one-off requests coming through you throughout the year. Another factor here that we're looking at is electronic timekeeping, and in your packet, you do have a spreadsheet that shows some of the dates, the timeline. So not only of implementation of when we would start utilizing electronic timekeeping, but also the lead time of which we would be able to educate all of the employees, those and the new employees coming on. Obviously, something like this, which is so important to, one, with the morale of the employees, but anything that disrupts pay, we certainly cannot have. we have to go into this with a lot of lead time, because if we mess up anyone's paychecks, there will be total chaos, not only in the finance or the HR department, but in every one of our departments, all of the employees, and certainly each of your phone numbers and your emails. So it does take a lot of prep work to get that done, which is why under this scenario, if we get this approval, we would have about 5 months of lead time to study it, implement it, test it, and get it operable. The other portion, so with electronic timekeeping, one of the issues that we have right now is we're collecting and verifying data of pay after a deposit or a paycheck has been made. That gives me a lot of heartburn, and it also gives people a lot of work to try to make those corrections. When anytime we're making corrections and working reactionarily, we know that there are going to be even more mistakes. There are going to be ones that we don't catch. That is a large liability. It is a large financial liability at times. It doesn't mean that we're losing money, but it is a potential liability. Certainly, if we can gather our data, study it, make sure things are as correct as possible, and then we issue the check, we're going to be in a better situation. Electronic timekeeping removes a lot of user error. That information goes into a spreadsheet. Any level of department leaders can review that before it goes on to payroll, so that payroll can then not have a lot of questions, is this correct or is this not? They are verifying that it's within budget, and they're making sure that things get transferred to and from the banks properly. That also opens us up for employee self-service functions that we aren't fully able to use right now. So if I need to know anything about my pay, if I'm applying for a loan and I need to print something out and I haven't saved that, I can go in and print that out for my underwriter. If I am considering taking time off coming up in the future, I can go into my self-service portal and I can see how many hours I want to use, and I can also see how many I have available. I can make that request in there. That can then be sent, that can be notified to my supervisor so that they can then look at it. And they can then see if we're going to be properly staffed. Do I have the proper time? And then they can approve or deny or suggest a different time for me to utilize it. Not only that, but if we're in a small staff, or if we are in a department that relies upon one another, such as shift work, I might be able to go in there, some of the ones that we're looking at, I might be able to go in there, look at the date that I'm considering taking a vacation with my family, but I can also see that this person, and this person has already scheduled that time. It's been approved. I know that I need to look at a different time instead of putting a difficult situation on my supervisor where they have to deny or be short-staffed. So it removes a lot of that chaos, if you will. Another thing we're looking at here is the biweekly pay periods. So one of the things that it can help employees have better cash flow. They can have, so many people live day to day. They're living paycheck to paycheck. And when the money hits, no matter how much they try, they have things that come up, and if the money is there and an opportunity presents itself to spend it, unfortunately, sometimes they spend it. If they do, they might have several weeks before they see another paycheck come through. This gives them another spot check every 14 days so that they know they have more money to spend, or they don't have it to spend. In recruitment, this can play a large factor, because if you start with an employer who is on a monthly schedule and you start somewhere mid-month, early month, you might not get paid. You don't get paid then, you get paid the following month. So that is even further delayed. So someone starting new, that removes a barrier for them to start to receive pay. Big thing is going to be fixing the date gap. So again, with this, when we implement biweekly pay periods, we would now be paying after the time has been worked and after the data has been collected and verified. So at that point, we would issue the check. On the timeline spreadsheet that I provided, one of the things that presents is that because we're paying later than we normally do, there will be a gap in that first month especially, where they would be receiving their typical payment. The first one of 14 days they will see before they would normally receive their monthly paycheck. The second portion of that, they are going to be receiving 10 days later than what they would normally receive when they would normally receive that paycheck. With it being a biweekly pay schedule, that decreases from 10 days. Each month it would get shorter from 10 days to 7 to 5 to 2, and then it would balance out by the end of June. Other things to consider why a biweekly pay period is beneficial for the entire organization is that we have a lot of departments who are on shift work, and those are 14-day shifts. Anytime that you operate with 14 and 28-day shifts and you're trying to mirror that or match that with a monthly payroll, like a general, it creates a lot of manipulation. So generally you can say we have the 14 days of a straight period of pay, and then you have the second 14 where you get to recalculate any of the earned overtime, comp time, those that was earned and those that were used. In addition, as we become utilizing technology more, there's a big push for that. I'd love to see, and I know finance would too, and many of the departments, is that if you were to ask me for a report right now, much of that has to be done manually. And not only that, but it's going to be greatly delayed. Again, if we're operating off of monthly payroll and then we're collecting the data 2 weeks later, then for us to get it all in and then run a report for you, the data is going to be late. If you always said, well, we understand that we'll just kind of make that mental adjustment, that would be one thing. It's still not as convenient or as accurate. But as you get into your touch points of the year of quarterly or 6 months, and you're beginning to project how the year is shaping up, you want that data to be as accurate or up to date as possible, because you're at the midpoint 6 months in and you're wanting to see how we're performing. Have we been overspending or not? And you're only saying, well, this might be 45 days short or 60 days short. Then you have to make that assumption as well. And we all know that in our government spending, everything is not monthly. Sometimes they're big projects, so you have big hits and small hits at infrequent times. So the pay schedule would help us fix a lot of things there. This also takes a lot of lead time for education. It takes time for people to finance properly, to plan for that. But there are several things in place, so to help bridge that 10-day gap, these are all concerns that we looked at and said, if we implement this, where's the hardship? This sounds great for operations and for data collection, but what is the burden upon the employee? That would be the gap. But we also looked at all of the benefits that we do have. So for those that have been here and receiving longevity, they would receive that payment in December. At the beginning of the year, we offer 16 hours of PTO, so that time would be available. And we also, one of the things we are proposing is that any employee, if they choose, and if they have time built up in comp time, PTO, vacation time, beginning in that January before it would be needed in February, they would be able to utilize up to 80 hours of their own earned time, not sick time, but the PTO, vacation, comp time. Those are liabilities on our books anyway. And a lot of times with short staffing, people just can't find the time to take it. But they would be able to utilize up to 80 hours. So that gives people the planning time, but also a financial opportunity to be able to make up for that gap as well. It just so happens, when I was looking at all of these when to implement this, I know we've been looking at it for a few years, but it just so happens that to do a 14-day cycle, of course, a full 28-day cycle, which our shifts operate off of, our month of February this year is not a leap year, so it is 28 days. Sunday is the 1st, so we'd be able to start when a lot of our shifts already rotate. They're already rotating and having a new shift on that Sunday. So we're able to capture everything with I believe, a more clear timeline or clean timeline. Also in that biweekly gap, that would balance us out at the end of June, which is on the very last day of June, which is the end of our fiscal year, which makes it nice. If we were to get the approval for the 80 hours of the time in lieu of, or payment in lieu of time, then they would be able to utilize that. Initially, I offered to be able to use that in January, so they'd be ready in February. But in some of our smaller group discussions with the commissioners, it was brought up, well, what if they needed it at different times? Maybe they didn't want to take all 80. Maybe they wanted to ration themselves. So we spoke with finance. Sorry, Nikki, you weren't here for that conversation. But we did look at saying, yes, that would not be a staff burden to be able to spread that out. If someone wanted to take a portion of that in January, a portion in February, they would be able to do that. Each time they'd have to have a request, but the end of that would be in June. So again, everything catches up by then anyway. They shouldn't need it anymore. And also for us to be able to have that show on our books for the fiscal year, that's another thing of keeping it clean. So those are everything that I have on the employee compensation portion. And we can either go into the other budget impacts, or if we would like to discuss now, it's at your choice.
Any questions or discussion? Commissioner Davis.
Tim, go back a few slides, which is the reason I like to get stuff ahead of time so I don't hold everybody up. But I did not follow your correction to the problem I thought we would have by some of these raises in January and then knowing next year they're all gonna be there again. You talked about something about a 3-year spread out that I just didn't keep up with. Could you go back to that slide and walk through it again?
This one here? Yes, sir.
Yes.
And what we have here is not going to give you multiple Excel spreadsheets to be able to show the comparison of that. But I will be working to give you some comfort of that, because initially you think that the hourly rates are going to increase so much that you're going to have an impactful next year, that it's going to overinflate the hourly rate, which is going to be your annual salary. So one of the oddities of it is that you are not, in each fiscal year, the second portion is not being experienced for the full 6 months, for the full 12 months, it's only for the 6 months. But in doing that, it gives you more money. That's easy to find. You can, I guess it's easier to comprehend. It gives you more money for that current fiscal year.
Correct.
And in fact, the way I would design it in that award is what we originally appropriate if you were to do that 4.5% for everyone for the entire year, which is the way we pull it out. That's the way we show it in the budget. We're portioning it out at different times. So when I go in and I have to receive, let's say I'm going to get all of the evaluations back. We're doing 2-tiered evaluations. We're doing a base level evaluation for every employee now. And then October and November, we will do a new evaluation, which will help us base our merit award. So when I do that factoring, what we assign, we have to see how many come back as meeting standards and how many come back as exceeding standards. That was a concern. What if everyone thinks that maybe they are, or maybe they think that every one of their employees is exceeding expectations, and that skew is so high when I say that we anticipate being able to give 4 or 4.5. But if we have too many of those, that messes up my calculation of what I propose. At that point, I have to skew that down. I'm going to have to bring that as a sliding scale, which no matter how it shakes out, it can't go over the budget amount for this year or the next year. And I have to bring that down, so it might be 3.75. If we think that highly, or we grade people that highly as overachievers, then that means that more people are going to get it, so the allotted amount of money which is awarded is going to be a smaller percentage. But it's really too much to show on this here, but I would love to be able to follow up with that after Jonathan and I have a chance, because he still has questions on it as well. In anticipation, and rightly so, that you would have those same questions.
Must be the engineer mentality, I reckon.
Or you know what kind of questions some people are going to ask.
Yes.
Yeah, well, and that was certainly Mr. Boone's thought, is that you're going to have this question, and I knew I would, and I knew I was not going to be able to show all of that here, because it does take, for me, you had brought up the question of what does that mean for next year, and I kind of said, point well taken, huge concern. And for me to be more comfortable with it, I have to show it over a 3-year period, just like anything else, because that is a mid-year cycle of 6-month changes. I want to see what it looks like over a couple of years.
So basically, we have more to come on that subject matter.
Yes, sir.
Okay, I'm good. Thank you.
Other questions or discussion? Commissioner Harrington?
Well, I guess right along that line, will you be setting a percentage of people, say in each department, that would exceed expectation? You know, since you want to know whether, okay, somebody say everybody in the department is exceeding expectation.
I believe with all the
Whether we have a
departments,
percentage?
yes and no. So I believe that I've set the expectation, at least I have it, that in most organizations worldwide, that you're going to have of your population, you're going to have somewhere around 10% of people that are underachieving, that most anybody could agree to. You're going to have 15-25% that are overachieving, and that middle gap are people that are generally doing their job. Some days they do a fantastic job, sometimes they're not giving it their all. And if I question myself on that, and I'm being honest with myself, I have to say that about myself sometimes. I think that I'm a high achiever, but I know that there are some times that I'm not giving it my all. But throughout the year, without having recency bias or other types of biases, you have to evaluate and say, are you overachieving? And those are going to be your 15 to 25%. However, we understand that it's difficult to do performance evaluations and have those conversations with people and tell them that you don't think as highly of them as they think of themselves. That is very difficult to do. But that is a conversation starter, and it's healthy for growth. It's healthy for us to be better producers. So these are all designed to be conversation starters so that people are working together better, being more productive. And so under that scenario, to answer your question a little bit more, if they're awarded really high, then we're just going to have to narrow, we're not going to be able to fund it as much there. They're not going to get as great of a percentage, and then we will gradually get back to judging and awarding honestly, hopefully. But we do want a separation. We definitely do want to give constructive feedback during an evaluation to let people know if they are meeting or exceeding or not meeting expectations. They have to have direction, and we have to hold them accountable and ourselves as leaders.
I want to look well, you know, I'm asked a question called, sometimes people say, I get here every day on time. They see that as exceeding expectations. But that's just meeting expectations. So I know you're going to have some criterias or your high set bars that what exceeding expectation really is. And I'm going to comment on this system that, the electronic system that, well, it's similar to what we use at Rock Mountain Engine Plant. And the key part is an employee self-service function.
Yes.
That you can see everything that you've done, you know, your time, you see how much time that you got, how much time, and you let your supervisor know when you're going to be off and all those things, and everybody's coordinating pretty much electronically the same message. So it takes a little bit to get used to, but it works.
Any other discussion?
One more thing, Mr.
Go
Chairman.
ahead, Commissioner Davis.
The time that we gave, for bad weather days, et cetera, how many hours?
16.
16 hours. Did I hear you say we gave that 16 hours, paid it out at the beginning of the year? Or how does it get paid out?
You get it credited to your balance account
In January.
in January.
In January, so you do it mid-year?
Calendar
mid-fiscal
year.
Calendar year.
It does not carry over.
It does not cut. What if an employee gets it and leaves in March? Do you try to recoup that, or you don't worry about it?
If it hasn't been used, it doesn't get used. Right.
Okay.
And then if somebody comes on mid-year, it's provided to them at a prorated amount.
Gotcha. Okay. All right, and my last question, I promise, Mr. Chairman,
But don't make your last question, we're not through yet.
on this subject matter, trying to properly ask this, how will the commissioners be paid moving forward, if we're going to bi-weekly checks?
However you want to.
Yeah, I was going to say, you get to choose that one, I do believe. Yes, so it depends. That also brings up the question of not just this board, but any of our other boards as well.
So we haven't discussed that yet, y'all haven't decided. Thank you.
Commissioner Leggett?
Got a question as far as like actually hands-on, when you're talking about electronic timekeeping for the employees. Let's say for the employees in the county building, what will that look like for them? Are you talking about going to a biometric time clock? Are they going to badge in or do something when they get actually to their individual office? I'm just curious.
We're looking at all of those options. The wish would be to be able to sign in electronically if you have that ability on your own. So if you have your own device that you would be able to sign in, that would have geofencing so that you could not be in the parking lot and sign in from there, that you're reported to work, but you would have to actually be within the building. So it does have that, what we're looking at, and those that we would most like to consider would be a part of that.
Thank you.
For those that failed to be able to clock in or whatnot, depending upon their position, their location, their style of work, or if they're called onto a site, that would be the responsibility of the supervisor to be accountable for that.
Any other commissioner have any questions, discussion? Manager?
Just want to add that we'd like to bring this to the board in your May meeting, the new pay schedule. we'd like to bring this to the board in your May meeting for a formal vote so that we can know whether or not to start the education campaign with our staff. And so these last parts of the discussion, as far as the schedule in which our board members would be paid, this board, as well as other boards and things like that, if you all wouldn't mind reaching out to me and giving me your feedback on that, so that we can have a little bit of direction to know how to prepare the presentation for bringing it to a vote of the board in your May meeting. Is that agreeable?
Will that conversation be in closed session that we tell you how we want to do it?
Well, can you, if you would reach out to me individually and let me know what your wishes are, will that work?
I'm good with it any way you want to do it. You got my input.
I didn't literally mean closed session, I meant, was she gonna keep it to herself? It was a humorous comment, sir, I'm sorry.
We need a little of that today.
Yeah.
It does it.
Any other discussion? All right, thank you, Tim. Moving on to budget impacts.
So budget impacts, these, you have a spreadsheet in your packet as well. So at the beginning of budget planning each year, the county manager asks each of the department heads to make any requests so that everything is on the table and everything shall be considered. As you know and recall, we've had several of these meetings leading up to this point. So there have been even further conversations between the county manager's office and each of the departments. And the final request here of what you have on the spreadsheet summarized is 23 requested positions, and 17 of those will be recommended or being recommended to you. A few of those 17 are recommended for partial year, not the full year, which means that, of course, that's going to have less of a financial impact on this upcoming fiscal year, but it would have a full impact, likely, if the position remains in all of next fiscal year and any year thereafter. So that is understood with this. You don't have that column. It felt like when I had that there, it might have gotten a little bit too confusing. So what you have is the units requested, units recommended. In the notes, it'll show if it was for 6 months, 12. If it doesn't say anything, it's for the full year. If it has a note there of 6 months or 3 months, then it would be eligible for hire, let's say in January, or let's say in April of the following year. And then the final column, so then you have the total request effect to the fiscal year 26, and of the request, and then the recommended.
Excuse me, may I interrupt?
Yes.
Excuse me, Tim,
Yes,
because
ma'am.
what I have in front of them isn't the most updated one, so I wanted to point out to the board, Tim is recognizing that we have 17 recommended positions. If you're looking at this handout that was in your packet behind the agenda, it actually shows 19 being recommended. The change is up at the top on the third line where we've got the request for the paramedics. Again, those were the paramedics that were for overstaffing, one for each shift. In talking with Dale and Travis, we were funding all 4 of those at a quarter of a year, the last quarter of the year. They would prefer to bring 2 on mid-year, so we're reducing that number from 4 to 2. The same amount of money will be utilized, but they would like to try to bring on overstaffing on 2 of their shifts mid-year, rather than have all 4 at the last quarter of the year. And so we do anticipate next year adding the other 2 to their budget to be able to overstaff on all 4 of their shifts. But that's where the differences are between the information that you see on the slide that Tim is going over and what you actually see on this chart here.
Any questions on that? Everybody clear? Yes, sir, Mr. Davis.
I know I'm the one that suggested overstaffing, and I totally support overstaffing in those key positions like that. But I didn't anticipate us adding positions, because if you're overstaffing, you're not adding positions, you're overstaffing because you anticipate you're gonna always have shortages. So why do we switch from overstaffing to adding positions?
We have to have the positions in place, and my finance department is nodding their heads. We have to have in-position control in our financial systems. We have to have those positions accounted for to be able to overstaff.
I fully understand that, but I just think we need to drop the worry of overstaffing, because at that point, we won't be overstaffing.
We'll just be staffing.
That's correct.
Yes, sir.
Okay.
Understood.
It's confusing to utilize it both ways.
Understood.
Thank you.
Thank you.
Everybody clear? Go ahead, Tim.
Yes, sir. So then you're going to see in the middle of that, and I don't believe this changed from the one that you have, there are 2 position reclasses. Policy as it stands now requires that if a position is greater than 10% increase or greater than 2 grades of change, that requires the commission's approval. These 2 that are in question, one is a 5% increase and one is a 10% increase. They would generally not be required. However, they are 4 grade differences. So that's why they're before you. In total, that amounts to $8,000 annually. Then you will have 3 positions that have been additional positions that are funded elsewhere, so through enterprise funds or other development. So one is opioid settlement funds, one is travel and tourism, and one is from the solid waste enterprise. And those also do not have a change from what we had reviewed in the past. So, employee health insurance. Later we will be talking about having a new broker potentially, but that is only for the ancillary coverages, all of those dental, vision, and anything elected. But with our primary medical, we are part of the state health plan. And one of the early benefits of the state health plan was consistency, lower cost to the employer and the employee. Well, unfortunately, the state treasurer has told us that things have not been operating as they originally planned. So therefore, there are going to be some big changes this year. They have been giving that news to us for several months now. Of course, those in HR and finance that are in tune to it all the time, we knew it was coming. We anticipated it when it started, but certainly over time, we've seen that it was not performing well. This happens to be the year when it's going to catch us. And in doing so, we will know a lot more information on April 24th. They've given us some roundabout guidelines, and what that is going to call for is an employer increase for the first time in 7 or 8 years. We have been looking at 3% and preparing and planning for that. We hope that it does not come back greater than that. Otherwise, we're going to have to, be discussing that again further in May and perhaps in June. So we have that planned for. The other portion is it's not going to just be the employee, not just the employer, but both. And what is being proposed for the employer portion or employee portion is likely to be tiered on salary ranges. So that might mean, and they have not set that yet. Hopefully they come out of that with the vote in April, or here in April 24th. But it might look something like those making up to $40,000 a year pay $25 a month per employee per month. Those between 40 and 100 pay $60, $70, $75 a month. Those who are 100 and greater pay $100 a month. So you can see for one employee, even at that, you're talking about $300 to $1,200 if that were the model that is going to be charged to the employee just for themselves, not even talking about dependent coverage. So that is going to be something that will be difficult for many. But that is what we're preparing for, and that's what we'll know a little bit more about coming soon. And as soon as I have that information, of course, I will be passing that on to the county manager to be able to share that with each of you. Also, in relation to that, on that same date, they are expected to be voting on the local government employee retirement system. So that is our, quote, state pension that we always hear. 2 decades ago, or a decade and a half ago, that contribution didn't seem to change. It was pretty steady. Those that have been in it a while, we've seen that. And now, we just know it's going up, and it's going up a fair amount every year. Don't know when that is going to balance out, but we can all assume that lots of baby boomers are hitting the retirement stage of life, and it's beginning to affect the system. It's more than what they anticipated, so therefore it has to be funded. But you can see for law enforcement, sworn LEO, that is going from, they've given us these estimates, they'll vote on it come the 24th. These, when they give us these estimates, they're normally spot on, or with a few hundred or thousandths of a point. It's pretty close. So the 1504 to 1610, that's what we anticipate. For the rest of the employees, 13.63 to 14.35. Dollar amount, what that equates to with our number of employees, our situation is 78.5 and then 264. So you're looking at well over $350,000 impact annually for the county on that portion. In this, what you don't see, but will be in that same vote, which will likely be the same, is the employees portion is not scheduled to change. That will remain the same, only the employer. And that's all I have.
Anybody have any comments or questions on that last segment? Okay, go ahead, Ken.
Okay, we'll keep going here. And now, as I mentioned and the manager mentioned earlier, for several reasons, it's healthy to always reevaluate your insurance broker, even when we're not doing the primary health, because there are so many other things that an insurance broker can do for the county. So, as I mentioned, our broker, we have a state health plan. This broker is looking after vision, dental, short-term disability, long-term disability, cancer, accident, all of those types of policies. Pet insurance if you want it. But what we have a lot of unique situations, and we need to get some proactive thoughts and solutions to some of our problems when we want to be able to offer what we can with low cost to our employees. We have other unique situations. We're not alone in it, that we have retirees. We've broached this subject before, but is there something that a broker could suggest to us that would be beneficial for both the retiree and the county? All those types of things. What I'd really like to see is the manager speaks of employer of choice. We're a large organization compared to others, municipalities and counties throughout the state. We're certainly not the largest, but we're large. But for us to be that large and still have the sense of family and care that we do, we're pretty unique. I come in as a bit of an outsider, living here neighborly down the road, and always having an eye on Nash. But I don't know coming into it everything that you experience. I don't know your environment, but I certainly know about a lot of the others. And we have a great thing going here. I don't say that this is what I'm telling everybody when I'm out and about with the other HR groups, when I get to see finance and others. But we can always do more, and I love that we have that environment that I can suggest a few things and bring it up here. One of the things I would love to see is a financial education and planning portion to our benefits. And when I've mentioned this to many people, other brokers, yeah, that's something that's there, but we don't really get into that. Well, I want someone who does stuff like that. If it's going to be low cost or no cost to us and they can give us a benefit, I want them to give it to us. I feel that if we can show that care and our employees have them know that they come to work and they are financially set, or we're looking out for their best interest and we give them that as a benefit, it will be appreciated. That's just one of the things why you look, is because there are other products out there, and sometimes brokers need to step up their game, and that was the design of this. Mark III has done a phenomenal job. They've done very well. We've been happy with them for years, but I also want to say, what is it that you can do better? So in doing that, we put it out for RFP so that everyone can propose. The proposal was a little bit strict because I think that we have some high standards on it. So if you don't have the capacity to service 700 full-time active employees, then it's likely not needed for you to apply on this. So we got some very good proposals. We had 5. From those 5, we narrowed it down to 3 and dove even deeper. Some of the selection criteria on it is understanding of the project, making sure that when they read the RFP and then they submitted it, that I could read it and say, yes, they understood what we're looking for. They responded appropriately. Methodology, that I didn't have to search all over for it. They should be presenting in a way that we can understand it. That they met the guidelines, of course, all of these did. We looked at their experience and qualifications. We looked at their resumes, their background of the staff, the organization as a whole, but also, and more especially, those that we would have the daily interaction with. So we have their background. The management plan, is it compatible with our software, with our financial software? Can it be compatible? Is it going to create chaos when we're trying to switch over? And cost of contracts, again, because it's not primary medical, that's not as much of a factor, but I was able to check each of those and give scenarios if an individual if it is an insurance that has age bearing, meaning you go up in class, you go up in price as you age, and some of those that don't have it, I was able to compare those. They were all very similar. There wouldn't have been one choice over another that stood out there. Big, of course, is where have you, where are you, how did they like you, what is that experience like? Checking references and testimonials. Again, there were some really good responses. There were some not as favorable, but we came down to, like I said, those 3, and they were very close, but the reference checks definitely allowed one to stand out, and that is through all of this process, that one that stood out is Gallagher. And so we are requesting in some way, if that needs to be by a formal vote or a consensus, but the reason that I need to be able to move forward on this is if we are going to make a change, we have to give notice to our current broker. If we're going to stay with them, we need to give them notice. But we have to give that to them 60 days prior to that rolling over, and that is the July 1 or June 30 date, which means I need to let them know by April 30th. So if we're going to make a change, in some way, I need to be able to have the official direction from that. One of the first things I did yesterday, or once she got settled, I went and met with Nikki when she got here and told her the process of which we were going through. And her first question was, of course, who submitted? Who are you looking at? And I told her the list, and with one, she really lit up with a smile and bright eyes when I mentioned this name. That was important to me. I would have not been as comfortable. Obviously, there's always reservation when you make a large change that affects every person in the organization. Not only that with the employees' insurance, but also this is going to, anytime you make a change, even without a change, there's a lot of heavy lifting, especially on the finance department, HR and finance. There's a lot of work to be done there. So I wanted to run that by her and see where she stood on it, and she really favors this company as well.
If we do this, we're gonna need to do it with a motion. I would assume that would be the right thing to do, but I'm gonna open it up for any discussion first from the board. Any questions or discussion? You see the recommendation on the board. Commissioner Davis?
Tim, you may think it's an unfair question. I think it's fair, but where you came from, Smithfield, I think, who did you utilize there?
During my tenure there, we had 3 or 4 brokers. The last one happened to be Gallagher.
And
But I actually transitioned to them, and I left before that actually took place. So we had that transition going in. And they were part of the InChip. So it was a little bit different. They were part of that North Carolina Health Insurance Plan, which is a subset. So they handled the major medical everything.
And our current broker, Mark III.
Yes, sir.
Were they one of the 5 that submitted?
Yes, sir.
And were they one of the 3 that were left?
Yes.
Okay. And more importantly, I think to everybody on this board, is this change going to do anything to the insurance for our retired employees?
No, sir.
Okay. That's all I have, Mr. Chairman.
Other questions? Commissioner Leggett?
If we change this provider, will there be any potentially negative experiences for our employees, or from what you can tell, only positive?
From what we'd anticipate, there would be no negative impact. What you cannot say for certain is, would one of those carriers change, such as a short-term disability? You can't say that for certain unless we said, I don't care if you find better pricing or better options with another one, we want to stay with this carrier. We have the ability to do that, but they go through the same process as you would with primary medical. So they're going to price it out. What you want to do is not to have a negative impact on the employee, certainly. But as much as we can keep that seamless for them, we would like for there to be fewer carriers in that bundle. It's easier administratively, but more importantly than that, because once you set it up, it becomes somewhat clockwork. More importantly than that, the employee forgets who they use. And if you're changing these companies all the time, it's nice to get into a commitment. Of course, you get a better price guarantee. But you know, if I have a claim and you're there and your spouse or your significant other's trying to help you and you say, I don't know, then they're having to go to our website. It gets confusing. It's nice to know that I have XYZ company. I don't like to change them all the time. This is not a fun process. But I'm taking all of that into account, certainly, because I'm going to get the phone calls before you do, and I'm going to be having to fix it.
Thank you.
Other questions? All right, you've heard the recommendation. Is there a motion? Recommendation's on the screen.
I make a motion to support the staff on the recommendation they gave.
Got a motion by Commissioner Davis, second by Commissioner Howell. Any further discussion? All in favor indicate by saying yes.
Yes.
Opposed, no. Motion passes. Thank you, Tim.
Thank you all.
Dr. Stanton. We can take a break. Yeah. Order. Call on Dr. Stanton for current recommended budget, revenues versus expenditures, and then the fund balance appropriation.
Okay, day 3, take it easy.
Take it easy.
Thank you. Okay, the first, well, where's my little clicker? On the other side. Okay, the first slide I have for you is our ad valorem tax calculations. As you will see on this side, right, we're budgeted at 97.5% collection rate. That gives us $69 million worth of revenue on our tax collections. As of 2023, I don't have the numbers for this past year, but as of 2023, our collection rate was 99.23%. So on the far side, that's 100% collection rate, which I assume we're at like 99.5 at this time. That's $71 million. When I was looking at this, I thought, well, maybe we should split the difference. That'll give us a little bit more revenue to work with here to close the gap, possibly. So at 98.75% collection rate, we go up to $70 million, which is a difference of $888,000 of additional revenue if we budgeted at a higher rate. I think we budgeted at 97.5 for a while. So that's my first slide for you, just at the explanation of the calculation for the revenues for tax collections. The next slide is our revenue summary. You'll see the revenues broken down. We go back to 2022-23. I show you 23-24, the approved and amended budget and the projection for 24-25, and then our anticipated budget for revenues for this year. As of right now, as you see at the bottom line, our fund balance appropriation highlighted in yellow, $6.8 million. That is our gap at this point.
And that's before we talk to the educators.
Yes. That is leaving their budget as it was last year, yes.
That's not going to be the case. Go ahead.
And the expenditure summary, this just breaks down where the expenditures are allocated. This does include, as you can see, the county capital request at $3.5 million. Are there any questions?
Anybody have any questions?
Commissioner Davis?
I understand you have a lot of tax calculations, and I see what you're doing, but when you calculate the shortfall at this point in time, what number will you use?
So this is 97.5.
Okay, thank you.
Yep, that's 97.5%.
I would sure hope we'd keep it there, thank you.
Other questions? Be ready to roll. No other questions? All right, anybody have any comments before we close it out?
Mr. Chairman,
Commissioner Wilkins?
I just want to bring everyone's attention to the item that Tim Kerrigan passed out to us, not to dwell on it at all, but I sat here and I totaled this up from January 2022 till March 2025, and a total of $552,248 was spent on discretionary raises that are at the discretion of the county manager. And just going forward, then the county manager explained that the merit would not be included in what she gives up to the 10%. And I would ask each board member to consider reducing that from 10% to 5%. That's $500,000 in, what, 3 years, 2.5 years.
Any other questions or discussion?
Chairman, I'd like to go last, because I always got a lot when we get to that point.
Well, is anybody, I'm gonna actually go last today, but does anybody else have any discussion or questions? You up, Commissioner Davis?
I'll just make these as things I'd like to know moving forward, if we could get those back at some point in time. I'd like an update on the number of employees we currently have working from home, whether it be part-time or full-time. On economic development, I noticed that we are putting, and we may have always done this way, but I don't think it's the proper way to do it, but for the new finance director, we are putting our agreed upon inducements agreements under an expense, under the Economic Development Fund. And I'd just like to make sure that's the proper way to do that. I don't recall seeing that before, but if we've been doing it, they were a smaller amount and didn't catch my attention, but we have a rather large one that's coming on board, and it's about $800,000 moving forward. But it looks like it'd be a better place to put that, so our economic development budget doesn't look like it's out of skew, which to me it does now at first glance. And when you compare it with other entities, I don't think you're gonna find them putting inducement agreements in there, because that could make that department look awful top heavy if we do that moving forward, if we just take another look at that. I would want us to do a check on library funding. It is proposed to be almost $1.2 million this time. We have partners in that. We have a formula by which we work under, and I'd like to make sure we're still following that formula and make sure the other partners are providing the funds that match what is proposed in our budget. School resource officers, the salary total went up quite a bit. I guess we are, what I'd like to know is we had a proposal from the sheriff sometime a little while back that proposed that we provide moving forward resource officers for all of our schools, regardless of location in the county. Are these numbers based on that, or are they the ones that we currently put resource officers in?
The current 10 that are approved.
Okay, well, I'd like to know why the salary percent of increase went up as much as it did, because it doesn't match what is proposed as an increase of salary for all employees. It's more increase than that.
Okay.
Apologize, Mike, but I ask this question about every 2 or 3 years. I'd like to receive a total cost for legal services for the past year. And I think we need to look at that to see if it is best to continue using an outside firm, or whether we should consider employing our own attorney on staff in addition to probably a couple we got in DSS already. Chairman brought up a point, but I do want to remind the board again that we have not even had meetings with our school systems yet, or our community college. In my proposed budget comments that we were asked to give some time ago, I did have an item in there about seeing if we could afford to increase this local supplement for our teachers moving forward. So just keep that in mind. And I am awful concerned about the total number of new employees. I don't think that I can recall in my time, ever had anywhere near what appears to be 19 today. I think it was 17, but we added 2 more back or something. Whatever the number is, it's still larger than what I have seen in the past. If we could look awful hard at that, I thought it might be driven by the detention center, but it is not driven by the detention center, and I think we all know we got additional employee needs that will show up there. And I'm thinking even before the end of the budget year that we're currently proposing the budget for, because of new areas open up. But I'm just concerned about that. That's a large number of employees, and moving forward, it's adding about $2 million of recurring expense for those employees to the budget. And of course, my biggest concern altogether is the amount of fund balance appropriation that we are required at this point in time. Another comment that I made is I'd like for us to adopt a budget this year without any use of fund balance appropriation, because we have lived on the backs of lapsed salaries to close that gap in the past. That doesn't seem to be the model that the current board wants to operate under. So if we're not going to have that cushion, we've got to get it right up front, knowing we may not have the lapsed salaries to balance it on or to get us back. And certainly at the end of the year, we do not want to come anywhere near $6, $7, or $8 million fund balance appropriation to balance the budget or actual expenditures at the end of the year. They were the things that stand out, Mr. Chairman, at this point in time. Thank you.
Any other comments? Any comments? Okay.
Excuse me, I did leave off one. Apologize. I do wish for us to make sure moving forward that under the outside agency fundings, we look at the criteria that Ms. Wilkins brought forward of bricks and mortar and see if that's a criteria we need to make an adjustment on. I think it's a valid point, and what I mean by that is if they actually got a facility in Nash County or in her thought process, Edgecombe County, I understand that point well, because it is Rocky Mount. But if that's a criteria we need to look at, if they actually got a facility here, we probably ought to certainly let the committee know that. Thank you, sir.
Any other board member have comments? Staff members, any comments?
If I could just clarify an earlier conversation, I did just want to, since we did talk about it publicly, I apologize to my Assistant County Manager, Ms. Tia Fula, because we did present the outside agency funding and did share with Commissioner Wilkins that we would make that change in the budget. I did have somebody question why we would do that when the board had established the committee to make the recommendation. And so I asked for that to be changed back, and she did let me know that she had emailed you that information, and my response to her was that I would reach out to you, and I failed to do that. And so I apologize again for that failure.
Okay. All right, I'm going to make a few brief remarks, and then I'm going to call for a motion to adjourn. First, I want to apologize to you, Gwen, for losing my composure. And next, I want to say this to this entire board. I have never, in my entire life, had my integrity questioned. And I take exception to that. I know what the word collude means, and if you don't, I'm going to tell you what it means. Cooperate in a secret or unlawful way in order to deceive or gain advantage over others. Now listen, I've been sitting in this chair since December, and I have been as totally transparent as I know to be. As a matter of fact, I may be transparent to a fault at times. I try to share with you everything I know. I do not keep anything from you. It has been my only goal, my only objective since I took this seat was to try to bring people together, because Lord knows we do enough fighting in Nash County. So that's what my objective has been. That's what I want to do, because I feel like if we bring people together, then together we're going to achieve more than if we go forward divided. So with that said, I want you to listen to me very closely when I say this. If I don't have the trust and the support of this board, then I don't want to sit in this chair. And I will gladly give this chair up immediately. If I don't have your trust and your support, if you think that I'm doing things that are inappropriate, not like they should be done, then I will gladly turn this chair over to Vice Chair Leggett or to any person that you so choose. Now, today's Wednesday, so you let me know by the end of this week if I have your trust and support. And if I do, I'll continue to function. If I don't, I'll move to District 5, and that's where I'll reside until my next election comes up. And I'll continue to do what I can do to bring people together. Is there a motion to adjourn? Moved by Commissioner Davis, second by Commissioner Howell. I assume there's no further discussion. All in favor indicate by saying yes. Yes. Opposed, no. We stand adjourned.